Sorry guys for the interruption. My bad. Can I request all of you to please switch on your cameras? Aaron. So what we were discussing before going on the break is that जो तुम्हारा systematic risk is not like the market risk which will remain same कि तुम कोई भी 40 stock खरीद लो, right? Like if you buy, let's say, a banking stock plus a FMCG stock का mix, the systematic risk can be a bit different from you buying the entire Nifty 50. ठीक है?
Sir,
Yeah.
sir, one last dot.
Mm-hmm.
So, whenever we are talking of the diversification, we will invest in equity, multiple asset classes like equity, currency, or fixed income, or commodity, whatever it may be. Correct?
Say it again. Sorry.
Whenever we are talking about the diversification, we can invest in any multiple class asset. That
Yeah.
may be equity, commodity, foreign currency, and whatever it may be,
Right.
fixed income.
Right.
So, what was my question? That let's assume that I have invested I have my one portfolio. I already in equity, so that is in fixed asset and either particular stock or indexes. There is particular risk and reward risk and return I have already calculated. So that another whatever multiple asset I am taking, that fixed income currency, what will be that particular return and risk, sir? That will be equal to my existing portfolio. How that will be calculated?
So when we say portfolio, you cannot say, "Acha, ये मेरा equity." अच्छा, मतलब see, you can have a equity portfolio, you can have a fixed income portfolio, you can have a real estate portfolio, but
Yes,
within that, I just call it an overall portfolio, which I bother about. जैसे अपन equity
that
portfolio में बात किया, right? कि there can be a firm specific risk.
has
There can be exactly same thing when you think about real estate.
that point I understood, sir. But picking of the multiple asset, अभी मैंने already equity का calculation कर रखा है कि भाई मेरा
Right.
इतना रिस्क रहेगा, मैं इतना 5 लाख तक इसमें इन्वेस्टमेंट करूंगा. अभी मैं फिक्स्ड इनकम को उठा रहा हूँ, तो फिक्स इनकम को ले रहा हूँ, तो उस टाइम पे मेरा कैलकुलेशन रेशियो कंपेरेटिव एग्जिस्टिंग
कौन
इक्विटी
सा
का ही
कैलकुलेशन
रहेगा.
रेशियो? अच्छा, डाइवर्सिफिकेशन रेशियो जो कैलकुलेट करने वाले वो।
हाँ सर.
अच्छा, वो अपन ने डिस्कस नहीं किया, मतलब तुम पढ़ के उसके बाद क्वेश्चन पूछ रहे हो मेरे से, राइट?
हाँ सर.
अच्छा अच्छा, तो लेट्स डू इट एंड देन अगर तुम्हें वही क्वेश्चन अगर वैसे कैलकुलेट करना पड़ेगा,
हाँ
यू
सर.
टॉकिंग लाइक व्हाट इज द डाइवर्सिफिकेशन रेशियो, राइट?
हाँ, डाइवर्सिफिकेशन रेशियो में जब हम मल्टीपल एसेट को पिक करते हैं तब हमारा उसके रिलेटेड डिसीजन क्या रहना चाहिए, वो क्वेश्चन था.
समझ गया, तो एक बार लेट्स इंट्रोड्यूस व्हाट इज डाइवर्सिफिकेशन रेशियो एंड देन आई विल आंसर योर
ओके.
क्वेश्चन, है ना? तो व्हाट द
ओके सर.
डाइवर्सिफिकेशन रेशियो इज, फर्स्ट ऑफ ऑल आई डोंट हैव लॉट्स ऑफ रिस्पेक्ट फॉर दिस रेशियो क्योंकि इट्स वेरी रैंडम. So what the diversification ratio does is, let's say there are 20 stocks in your portfolio, and you see that you pick any random stock from your portfolio, right? And you see what is the standard deviation of that portfolio. Sorry, there are 20 shares in your portfolio. You pick, let's say, share A and see what is the standard deviation of that particular share. Okay? So let's say the standard deviation of that share is 25% as given in your books. The second thing you do is, for all those 20 shares in the portfolio, assuming that equal weighted, you try to see what will be the portfolio risk for an equal weighted portfolio. And let's say that risk turns out to be 18% as per your books. So what you're saying is that if you had invested in a single stock, the risk would have been 25%. But because you put your eggs in different baskets, the risk is only 18%. So here the diversification ratio is 18% divided by 25%, which is 0.72. That because of having a portfolio perspective, you could reduce the risk from 1 point to 0.72 points. So lower the diversification ratio, better it is. Now, in this case, the reason I don't have lots of respect for this ratio is, let's say if you had picked another stock which had a standard deviation of 15%, the diversification ratio will be more than 1. So it's very random. Like, what is the standard deviation of the share which you're picking up to compare with the portfolio standard deviation? Now, that being said, when we calculate this diversification ratio, Let's say you have a bunch of equities, you have bunch of fixed income, you have bunch of real estate. So if you're calculating the diversification ratio for real estate, you'll take one real estate in this bunch and compare with the standard deviation of all the real estate in this here. Is that your question, Rakesh? So you cannot compare
Correct.
standard deviation of real estate with the overall standard deviation of the portfolio. That will be very wrong.
Okay.
And you understand
So
why do I have a criticism on this ratio? Because it's very random. Like which one do you pick up?
okay. So हम लोग इंडिविजुअली करते जाते हैं कि इसका रिस्क कितना रहेगा
नहीं
इसका
नहीं
risk,
नहीं नहीं नहीं. You just like तुम्हें you want to see अरे how diversified my portfolio is. You're curious about it.
yes.
So you just randomly take one stock,
Okay.
see the standard deviation, compare with the portfolio standard deviation, and that's it.
Okay.
And that's your
uh,
conclusion.
okay, हम इंडिविजुअल स्टॉक को ओवरऑल पोर्टफोलियो से कंपेयर करते हैं.
हाँ. And that will give you an idea, right? कि अगर इंडिविजुअल स्टॉक में डालते हैं तो 25% रिस्क आता, बट पूरे पोर्टफोलियो में डाल रहे हैं तो 18% आ रहा है,
Okay.
right? It means because of portfolio, it's beneficial for you. And how much
Yes.
beneficial? That a risk of 25% is now is only an risk of 18%.
Is this same for the fixed income and commodity products as well?
Yes, right. But I'm saying that you don't do it for all the stocks, for all the fixed income, for all the real estate properties. You
Okay.
randomly do it for one or two and just try
Okay.
to understand that how beneficial it is to diversify.
Okay.
So in this case, if the stock you pick is very highly risky, you'll see that it's very beneficial to go for the portfolio perspective. But by chance, if you pick a stock which is very low risk, you may not see a significant benefit to go to a portfolio perspective.
Sir, but my portfolio, if that point is belongs to my efficient front eye, sir, that yesterday or last week which you have discussed, whichever showing me low risk. So is that will be beneficial? How
No,
that method
but see,
will
in
work,
this
sir?
case, यहाँ पे returns तो कुछ आ ही नहीं रहा ना. खाली the focus is entirely on risk. We are not seeing how much return you'll get corresponding to that
Yes.
risk.
Okay.
So I'm sharing the screen already, right? So let's say there are just 5 shares in the portfolio, and this has a risk of 25%. This has a risk of 15%. This has a risk of 16%. This has a risk of 12%, and this has a risk of, let's say, 16%. Now, if you do a weighted average standard deviation, let's say that number comes to 18%, right? Also, it cannot come 18%, it'll come to like maybe less than 18. Let's say it comes to 14%. Now, I'm saying that if you pick this stock standard deviation and compare with the portfolio standard deviation, you'll be like, wow, I'm getting so much diversification benefit. But if you pick this stock and compare with the portfolio standard deviation, you'll say that I'm not getting any diversification benefit here. So are you going to do it for all the 5 stocks? No, you'll just do it randomly for 1 or 2 stocks. So the stock you're picking up will decide. Now, the flip side here is one could argue that if there are multiple stocks in the same basket, they'll have a similar standard deviation. That standard deviation cannot be 25% versus 12% if you're investing into equity market. If one stock has a standard deviation of 25, the other might have 20 or 22 or 23 or 24, but there cannot be a difference of 15 versus 25. So as a result, whether you take this stock, this stock, this stock, you'll get a similar conclusion that it makes a significant difference if you diversify your portfolio. But still,
Okay.
20% versus 14% is very small, but 25% versus 14%, the gap is pretty large.
So before picking stock itself, we have to analyze that कि वो जो differentiation return का risk का differentiation ज़्यादा नहीं रहना चाहिए.
नहीं. Again, you are missing the point. Here you already built your portfolio. सब कुछ हो गया तुम्हारा.
हाँ.
And randomly तुम्हें देखना है कि diversification ratio कैसा है, like how good your portfolio is from diversification perspective. So if Rakesh has got 50 stocks, he'll simply pick one stock and see what is the standard deviation of this stock compared to the
Yes.
portfolio.
Understood.
And whatever conclusion he gets, he's assumed that this is true for all the other 49 shares as well.
Other 49 shares. Understood.
Okay? A lower diversification ratio indicates a greater risk reduction benefit from diversification, as I told you, right? Lower the diversification ratio, better it is. So if 25% becomes 18%, the ratio will become 0.72. So in this case, how do we calculate ratio? The ratio is nothing but how much is 14% divided by 25%. So it means that अगर मैं portfolio बनाता तो मेरा 14% risk होता, but because I invested in single stock, my risk is 25%. So because of making a portfolio, my risk is only 56% of the single stock investment. But if I do the same ratio for stock B, my 20% would have become 14%. So my risk would have reduced only to 70%. So in this case, if you take stock A, the diversification ratio looks better. But if you take stock B, the diversification ratio still okay, but not as good as 56%. So lower the diversification ratio, better it is. Okay, now guys, this is where I'll go a bit slow, and this is a lot of qualitative stuff, as I told you before. What are the 3 steps in a portfolio management process? One is planning step. Let's say I'm the portfolio manager and you are my clients. I'm going to do a lots of planning with you guys. What kind of planning I'm going to do? I'm going to ask you lots of personal questions. What are those personal questions? I'm going to ask you your salary. I'm going to ask you your expenses. I'm going to ask you your age. I'm going to ask you your hobbies. You'll tell me like, why hobbies? Why do you need my hobbies? I'll tell you about it. But I'm going to ask you about your financial goals. What are your commitments? What are your responsibilities? Who all people are there in your family? Who are you responsible for? Who are responsible for you? This entire thing goes into something called investment policy statement. It's called IPS. So if I'm managing, let's say 10 clients like you, I'm going to make a 1 or 2 pages summary, which has all the details which I need about you as an investor. So on a particular day, if I have to invest money in a particular stock, maybe I'll take out Ria's file and see, acha, yeah, Ria ke liye this doesn't make sense because she wants to take lots of risk, but this stock is a low risk stock. Huh, this stock makes a lot more sense maybe for Sovik, who is a low risk investor, and this aligns with his risk requirement. So this is a very important thing, guys. There's no one size fits all in portfolio management. As a portfolio manager, मुझे लगता है कि stock XYZ is very good. Let's buy it for all the clients is a very big violation from my perspective. क्योंकि a stock which is good for Ria may not be good for Sovik, and what is good for Sovik may not be good for Nandini. So there are lots of questions in ethics. You'll get that, I bought the shares for everyone. These all things are complete breach of standards. So how do I know what is required for each one of you individually? This is my guiding light, which is investment policy statement. Then I do the execution. ठीक है, Ria को low risk, sorry, Ria wants a high risk. Then I do a top-down analysis. What is a top-down analysis? I'm coming from the top. How do I start as a portfolio manager? Yeah, ठीक है, let's say looking at the global market, does it make sense to invest money at all? If it doesn't make sense to invest money, maybe I'll put Ria's money into in cash. When I say cash, I'm not just like putting it in like black polythene bags in my bag in hard cash. I am putting her money into like something which is risk-free treasury bonds. Because I think that the markets can go bad. If the markets go bad, The treasury bonds will still give her the fixed rate of return. But if I think that the markets are going to do better, I'm going to put her money into stocks, into corporate bonds, into real estate, and those kind of things. Once I decide that, okay, it's a good time to invest in the global economy, maybe I'll decide which economy is going to do better. Is India going to do better than rest of the world? If it's India, then I decide, okay, within India, whether the equity is going to do better or fixed income is going to do better or real estate is going to do better. Then let's say I decide in equity is going to do better. Then within equity, which sector is going to do good? Is it a chemical sector, metals and mining sector, oil and gas sector? Once I decide that, I decide, okay, which company is going to do better within this sector? This is like a top-down approach. I'm coming from the top. Some people have a bottom-up approach as well. What is the bottom-up approach? This particular Bajaj Finance as a stock looks very good. I think I should invest into it. Oh, I want to invest into Bajaj Finance, but is it a good time to invest into any finance stock currently? हाँ यार, finance sector is going to do good, but is it a good time to invest into equity market? हाँ यार, it's a good time to invest into equity market. Oh, is India going to do better? So this is like a bottom up. You're starting from the bottom and then you're going towards the top. What is more systematic, guys? Top down or bottom up?
Sir, I feel top-down analysis is better. I mean,
Yeah, that's
um,
like more systematic.
yes.
Then the feedback step. Like you do the planning, you invest the money for your clients based on that. But the feedback step is just because when you invested the money, don't leave it there. Maybe I put Ria's money in one of the stock which I thought is going to do better, but it's not giving good returns. So it's a time for me to sit back and think about, did I make a right investment? Has my expectation, what I expected about the stock is going correct? Is it still a good investment? Should I increase her stake in the share? Should I reduce the stake? And those kind of questions. It's a ongoing thing. So you have to keep rebalancing the portfolio. So guys, these are the three main steps and we are going to do further work on it. One is planning step. So how to write an IPS, what is an IPS, what are the components of IPS, we're going to talk about it. There's an execution step with a top-down or a bottom-up approach. And a feedback step, we keep rebalancing and you keep revisiting your expectations and what the actual thing is happening. Now, before doing any further work, if I'm the portfolio manager, I may get clients who are individuals like you guys are, right? Or my clients can include a large institute. So sometimes a portfolio manager is managing money for a bank. Let's say there's a bank and they have got like extra 30 crore rupees sitting on their balance sheet, which they don't need for next 2 months. They can go to a portfolio manager and say, okay, please put my 30 crore rupees. A mutual fund can come, sorry, not a mutual fund. A insurance company can come to a portfolio manager. So guys, the institute are those people who got lots of money. So the institutes are those people who got lots of money. How will they get lots of money? Take an example. Bank, yes, they got lots of deposits. From there, they can get some extra funds. Insurance companies, where the insurance companies get money from? The premiums you pay. But guys, once you pay the premium, do you go and claim the losses then and there? So there's a point of time that the insurance company is keeping those claims, and there'll be a point of time before which you go and get the claim for. Now, there could be two types of insurance companies, which is important for our discussion. One is we call it a life insurance companies, and the other one is a property and casualty insurance companies. How many of you have an insurance, like a car insurance or a health insurance or a medical insurance, anything? May I request Samay, Ria, Rakesh, Nadia, all of you guys to please switch on your cameras. And guys, please keep it on. Any of you have an insurance? Any kind of insurance? When I say you, like you, your parents, somebody in your family. Okay, so think about if I take a car insurance, like my car insurance, I think I pay 9,000, 10,000 rupees insurance premium. That's about it. And I've been paying car insurance premium from past 5 years. What do you think? How many times have I claimed any losses on my car insurance? Make a guess, like once, twice, 10 times, 20 times. I'm a very okay driver. Like,
Five to six.
so you're saying like once in a year almost?
Yes.
कोई ना कोई scratch लग जाएगा, कोई dent हो जाएगा, something will happen, right?
Ah, sir. Oh, sir.
So not 5 times, but yeah, I've taken it like 3 times in past 5 years. The insurance claim.
Ah,
Okay. And guys, by the way, I also have a life insurance. This guy I pay a premium of like 25,000 rupees every year. How many times I would have claimed? And I'm doing it from past 15 years. How many times I would have claimed the life insurance loss claim? Guys, I'm alive. So you're getting my point, right? I've not claimed it yet, it means. So if you put your money with the car insurance company, the car insurance company knows that this customer will come and claim losses within next couple of years. But if it's a life insurance company, the company knows that this person is not going to come back in next 20, 25, 30 years to claim the money back. So within insurance companies, guys, who will have a more longer investment horizon is a life insurance company rather than a car insurance company or a property insurance company. And why am I so much particular about the investment horizon? Because if your investment horizon is longer, you can take more risk. Just like a young professional versus a old retired professional, right? Now, similarly, if you talk about endowment, what is an endowment? Let's say I've got some 10 crore rupees which I want to contribute to the society, or I want to support some particular activity within the society. So what I do is I create an endowment and put the 10 crore rupees into that endowment. The purpose of that endowment is to simply put that money over a period of time for that particular purpose. So many times it's possible, right? Let's say as an old person, like I'm 85-year old, I want to donate that 10 crore rupees to a particular program. And I don't want to put the entire 10 crore rupees in a lump sum. I'll give you one of the examples, guys, right? So एक बार ऐसा था कि one of the person wanted to put money for the education of 100 people for the next 10 years till they become like, major. Now, this person who wanted to contribute is like terminally ill and have a life remaining of maybe a couple of years. So this person opened an endowment and all the legal work and everything has been done. And this endowment ka money can only be used to make the payment to these 100 kids for their study purpose. But if it's a portfolio of 10 crore rupees, on day one, you're just giving like 10 lakh, 20 lakh rupees to these people. The remaining 9 crore, 80 lakh rupees are still sitting in the fund, which you want to invest and make some returns out of it. So this is a typical purpose of an endowment. An endowment has got lots of money with them. Other purpose could be foundation. So in this case, the foundation can be again for a charitable purpose, right? Banks we already talked about. Insurance company we talked about, but within insurance companies, guys, it could be a life insurance company versus a property and casualty insurance company we talked about. Investment banks like mutual funds and all, they have got lots of money. The government has got lots of money, like sovereign wealth bonds. Now, guys, I'm not sure whether you heard about it. ADIA, Abu Dhabi Investment Authority, they are like super rich sovereign wealth. They've got lots of government funds, which they keep investing everywhere. So this is the table I wanted to get to. For each of these clients, you as an individual, you as an insurance company, you as a mutual fund, or you as a pension fund. Pension fund के पास भी बहुत पैसा होता है, guys, right? What is a pension fund does? Let's say my pension fund, my company is putting, let's say, some money on a monthly basis. And at the time of retirement, I'll get that money back. But for those 30, 40, 50 years, the pension fund has got that money. What are they doing with that money? They take this money to a portfolio manager and invest that money somewhere through a portfolio manager. So if I'm the portfolio manager, my clients may include a pension fund. Okay? So if you're talking about the individuals, what is the risk tolerance? It depends on individual. What's the investment horizon? It depends. Liquidity needs, it depends. Income need, it depends. So this is the problem, guys. With individuals, you cannot standardize anything. All individuals are different. The risk tolerance of Rakesh can be very, very different from the risk tolerance of Souvik. Investment horizon, let's say my client is 25-year-old versus another client who's 70-year-old. The investment horizon will be very, very different. What is liquidity needs? The liquidity needs means that, okay, let's say Ria has got a portfolio of 10 crore rupees, but out of that 10 crore rupees, she needs 4 crore rupees to buy a house 1 year down the line. She's young, right? She can invest for a long term. But out of 10 crore rupees, can I invest entire 10 crore rupees for the long term? No. She has a liquidity need of 4 crore rupees. Only 6 crore rupees can be invested for the long term purpose. What are the income needs? Let's say Ria has got a full-time job and she's making a couple of lakh rupees every month. She doesn't rely on the portfolio to support her monthly expenses. But let's say I'm a retired professional. I need the dividend, I need the rent, I need the interest from the portfolio to derive my day-to-day expenses. So this is nothing but the income needs. So in this case, individuals, nothing can be standardized. Each individual is different. And based on each individual, you create an investment policy statement for that individual to decide what the risk tolerance, investment horizon, liquidity needs, and the income needs. But if you talk about an institute like a bank, what's main job of bank? Not to invest money in the markets or anywhere, is to take money from the customers, give money to the customers. But there could be a time that for a short period of time, they got extra funds. For that short period of time, they want to invest money into the markets. So as a result, their investment horizon is short. And guys, investment horizon short होगा तो risk tolerance अपने आप ही कम हो जाएगी. If you're going to invest money for 6 months, can you invest into equity markets? No. Can you invest money into anything risky? No. What if within 6 months everything crash? You need your money after 6 months. But do you want to withdraw when the markets are at the bottom? No. So I would say the risk tolerance and the investment horizon generally go hand in hand. There could be some deviation, but generally they are around the same. So shorter the investment horizon, lower is the risk tolerance, and longer the investment horizon, higher is the risk tolerance. But the liquidity need for a bank is very high. They need all the money in next 1 or 2 months. And guys, they have an income need. They want the fund to pay them returns so that they can pay interest to the customers who deposited the funds with the bank. Endowment, as I told you, they can be long term. So the investment horizon is long, the risk tolerance is high. The liquidity needs may not be that high because maybe you need money only after 5 years or 10 years. For insurance companies, if it's a life insurance company, the investment horizon is long. But if it's a property and casualty insurance company, the investment horizon is short. Now, guys, there's a very important thing is the purpose of the fund. Okay? So let's say Rakesh is investing his 1 crore rupees with me, and his purpose is that he wants to go for a world trip. How much risk can he take with this 1 crore rupees? He wants to invest this money for 3 years because after 3 years he wants to go for a world trip. If he takes risk, his 1 crore might become 1.5 crore, but there's a chance it can also become 0.8 crore. What do you think? Should Rakesh take the risk with this 1 crore rupees?
Yes, sir.
Are you fine with this becoming 0.8?
No, sir, I don't think so. You should take that.
Let's say a 0.8 ho gaya, so what will happen to Rakesh? What will he do with his world trip?
Sir, I feel that we can take the risk sir, because 0.8 हो गया तो कुछ, बट 1.5 हो गया तो भी बहुत बेनिफिट है सर, तो इसके लिए मुझे अच्छा लग रहा
हाँ, तो 1.5 हो गया, you can stay in all the 7-star hotels, you can
है।
get into lots
क्योंकि
more adventure
उन दोनों का
activities.
गैप उतना बड़ा नहीं है सर, आई
नहीं,
मीन
it's not about the
मुझे
gap. So let's say this is 1.2 versus 0.8. So it's not about the gap, but I'm just saying that अगर 1.2 हो गया, you can have a better experience. पर अगर कम हो गया, ठीक है यार, 1-2 घंटे मत जाना, 5
हाँ
स्टार की जगह 4 स्टार में रुक जाना, 3 दिन की जगह 2 दिन
मैनेज
चले
कर।
जाना हर कंट्री में,
यस
right? But think about, it's not Rakesh, let's say this person XYZ, or let's say we have got Ria. She has got 1 crore rupees to be invested, but her purpose is not world trip. Her purpose is that after 5 years, she has got an admission into MIT already, and she has to deposit 1 crore rupees exactly after 5 years to get an admission into MIT. She has a choice to invest into similar portfolio, which can go up to 1.2, but can also go down to 0.8, or invest into another portfolio which will never go down, but can go up to 1.05. The upside is limited as well. What do you think Ria is going to do? What happens if it becomes 1.2? Along with the fees, she gets some extra funding to do something more luxurious, like rather than just paying the fees. But if it becomes 0.8, what happens? No career
लॉस्ट हुआ।
for Ria, no MIT, sorry. Can you afford it? Nope. So as a result, in this case, Ria will go with this setup. Because the sensitivity or maybe like the importance is a lot more, that you can't afford a downside here. So going by that logic, guys, for an insurance company, can you tell a client, "Arey yaar, your relative is dead, but you know what, we don't have money currently"? You can't, right? And the regulators are very, very strict about it. So as a result, the insurance companies cannot take a lot of risk, but the endowment can take more risk. So let's say if your 10 crore becomes 9 crore rupees, you won't fund those people for 10 years. Maybe you'll fund those kids for 9 years. But if your endowment increases, you can fund those kids for more years, right? So as a result, there's more flexibility in case of endowments rather than the insurance. Mutual funds, it depends. Pension funds. Now, guys, they are a very long fund. They are very long term. Because pension starts getting deducted when you're 20, 21, 22 year old, and you need money only after 65 years. So given such a huge investment horizon, the risk tolerance is very, very high here. So guys, what is defined contribution versus what is defined benefit pension plan? We are going to do it as a part of financial statement analysis. If you're not done it already, there's a chapter on pension and we are going to talk about these. If you've done it, it's good. If you're not done it, we'll do it there. Now there are different types of investment. One is active management versus passive management. Passive management is simply putting your money in an index. Active management would mean that, okay, I don't want to put, I don't want to buy all the Nifty 50 shares. I want to buy maybe these 40, but I don't want to buy these 10. Rather than these 10, I want to buy another 10. So that's like a active management. Oh, by the way, guys, you know the difference between buy side and the sell side funds, right? All of you, buy side versus sell side?
Yes.
Buy side are the people who are investing money in the market based on the research they do. Sell side people are not the investor. They do the research and sell the research to somebody else.
They provide service, sir, basically.
Yeah. Now, obviously, the fees under passive management will be a lot less, and the fees under active management will be a lot more. Because in case of active management, they are doing more work to identify which stocks to invest into. Now, guys, stocks can be, the money can be invested into traditional or alternative classes. Which are the traditional classes, by the way? So we can divide the class into traditional or alternative.
Equity, debt, and these are the traditional.
Equity and debt are the traditional. What do you think land is? Is it traditional or alternative?
Alternate.
What about gold as a commodity?
Commodities also alternative.
And this is where I have a huge problem, right? May I request all of you to please switch on your cameras? Try to think about what did your, not father, but what your grandfathers or grandmother invested money into. What your grandparents invested money into. Not your grandparents or my grandparents, like a typical grandparent in India, what they did invest money into.
Gold.
Gold, house, land. My grandparents didn't know what equity market is, by the way. Isn't it very, very surprising कि यार मतलब what is traditional is actually equity and debt. I don't remember like our grandparents investing money into equity and debt. It should be ulta, na? Like this should be traditional, but this is like abhi alternative ho gaya. Any reactions to that?
And like currently, this thing has changed. Like, like current scenario, the equity and debt are more common investments.
No, but you're calling them traditional. मतलब like पुराने जमाने से लोग उसमें invest करते हुए आ रहे हैं.
Maybe US के perspective से they are more traditional investments.
Okay, yeah, that's one perspective. It's not like India's perspective. Maybe it's like a global perspective. But guys, the problem here is that when a typical Indian family put money into gold, I won't call it as an investment. What is an investment? That's a very important thing. That's like the elephant in the room. The investment is where you want to make money out of it. Simple, right? I'm not saying anything very, very, which is a rocket science. The whole objective of making an investment is that you want to make return out of it. And from that definition, our grandparents investing into gold was never an investment. Have you ever seen any Indian family selling gold? Are gold price ऊपर हो गया है? Let's go and sell gold in the market. Why not? I told my wife, by the way, like couple of months back, the news Anna market like it's at an all-time high. I said, why don't you sell some of your jewelry which you're not using? And she became very angry. So forget about the grandparents and your parents. Even our generation, can you sell gold? No. No, it's not an investment. It would have been an investment if you're ready to sell the gold when the prices are higher and you buy more when the prices are low. But no, you're emotionally stuck with that asset class. How can you call it as an investment? कभी हुआ है कि तुमने अपना घर बेच दिया, अरे यार प्राइसेस, रियल एस्टेट प्राइसेस आर वेरी हाई, लेट्स सेल द लैंड, लेट्स sell the farm? No. So for that practical purpose, guys, even from India's perspective, when your grandparents put money into gold, put money into buying a land or your own house, please don't call it as an investment. As a result, historically, traditionally, people have invested money into equity and debt. But now recently, people have started investing money into gold and real estate, even from India's perspective. Huh. You buying a sovereign gold bond investment. You buying a house so that you can rent it out and you can sell when the market prices are higher. That's an investment. Is it logical? So anything other than equity and debt is alternative. Now, guys, the passive management is growing. Just like these are like some industry trends globally, that more and more people are investing money into passive management. Why passive management? Because if a portfolio manager is an active portfolio manager, that portfolio manager may beat the market or can get a higher return, maybe 1% higher return. But to generate that 1% higher return, if you look at the historical data, they're charging you 2% management fees. So this is the equation. Either I simply put your money into a passive fund, your returns and the gross returns will be only 12%. I'm going to charge you a fees which is equal to 0.5%. So your net return is equal to 12% minus half a percent, which is equal to 11.5%. But if you look at the historical data and look for the active management, yes, the returns have been higher, but they charge you a fees which is a lot higher. So if you look at the net return is actually lower. And this is the truth, guys. So what will you do? Do you want this higher return? No, I'm okay with this lower return, because on a net basis, here I'm getting more than what I'm getting here. So for the active portfolio managers, the higher fees they are taking, which is 1.5% more, does not justify the higher returns they are generating. And this is what has happened in the last few decades. So people think that it's not worth putting the money here. It's good that you put money here. Give me 1 second, guys.
Sir,
Yeah.
sir, if the people are focusing on passive return, so in this case, active people demand is coming down, sir. It means that whatever we are hiring the particular manager or the whatever you are taking the decision. So in that case, that particular thing should be reduced, no, sir. I mean, either they should provide more return or the fees should reduce.
Right. So this is what, so the market share for passive management has been growing over time.
Okay.
This is because of the lower fees they charge. And the main question here is whether active managers are actually able to add value over time. Now, guys, the second important thing is the amount of data which is available. And we covered this in a part when we did which topic? Corporate finance, corporate issues as a topic, right? When did we cover this entire big data thing? Quants ke andar, sorry.
Quants.
So the amount of data is quite large, and as a result, each fund house needs their own team to process that data using tech or other tools. And the third thing is a robo advisor. It means, like everything can be done through AI and machine learning. And because of that, there are robo advisors who will recommend the investments to the investors without using any human component. Okay?
And
Yeah.
one thing like in the alternative investment topic, there are few questions on the management fee calculation and all those things. So I think when we did the alternative investment class, those things are not covered. So can you
Did
like
we not cover like which?
I think you were not taking the second part or something. Like I think someone else took the classes.
Acha, 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 because I do that there in that topic, but I
Uh,
didn't do it. Yeah,
that
somebody else
part
did.
was not covered. So like if you had few some time at the end
Sure,
of the
sure. Remind me, just make a note. I
uh,
think we'll have some time. Not today, but tomorrow. We'll do
okay.
it for sure. Okay? So let's take a break, guys. थोड़ा सा यहाँ पे theory है, but guys, it's going to get more interesting as we go further. And the good thing is there's no numbers and all, but don't take it as a theory. This is like a real thing. This is a real struggle of a portfolio manager, and this is what actually happens in the real world. है ना? So take it with that real market wala feel. You'll enjoy it a bit more. We'll take a break. It's 10:26. We'll be back at 10:45 and then continue. Okay, guys, welcome back. Let me know when you're back and can switch on your cameras. Let's give it another 15 seconds for people to switch on their cameras so that I know they're back. Arav, Aran, Anushka, Nadia. Riya, Rakesh, and Savik. Cool. We're still waiting for Riya and Nadia. Thank you, guys. So here, when we talk about a mutual fund, and for that purpose, forget about a mutual fund. If you talk about a fund, like a hedge fund, a mutual fund, technically what we are saying is a pooled investment. What is a pooled investment? The multiple people coming together, putting the money in that fund, and that fund invests money into different assets or different equities or different debt. So in this case, let's say as an investor, I want to invest money into real estate and I've got a total portfolio of, sorry, I want to make an investment of 20 lakh rupees. There's no way I can diversify my portfolio with 20 lakh rupees within real estate, right? In India, if I can buy one real estate property with 20 lakh rupees, I'll have to go to maybe like a third tier city and that too in outskirts. Maybe I'll be able to buy one BHK house. And on top of that, I want to diversify metro versus non-metro, rural versus urban, commercial versus residential with 20 lakh rupees. It's impossible. But what I can do is not just me alone putting 20 lakh rupees, but there are other 1,000 people putting that 20 lakh rupees. The total corpus becomes 200 crore rupees. And the fund invests that 200 crore rupees into various assets. Now, because I'm one of the 1,000 investors, I own 0.1% in all the investments. But I don't own like a single investment. I own too many investment and maybe 0.1% in all the investments. Okay. Now, in this case, this is the advantage of a pool investment that multiple investors come together. As a result, the size of the funds are pretty large at times. The funds can be open-end or a closed-end fund. Open-end fund, you're allowed to invest into the fund and redeem your funds or just like sell your funds anytime you want. So most of the funds which are open-ended funds are the ones which invest money into public securities. So let's say if you invest into a mutual fund and the mutual fund is investing money into public equities, there will generally be an open-ended fund. But let's say there's a private equity fund. The minute I use the word fund, the same funder, the many investors coming together, creating a fund, but the objective of the fund is not to invest money into public equities, but is to invest money into private equities. Now, let's say if that fund invests money into private equities. Can the fund take out the money back from private equities? No. So they do not allow the investors into the fund to take the money out. And there'll be a lock-in period, maybe 2 years or 3 years. So these are what we call as closed-end funds. Generally, the fund manager may charge some fees. If they don't charge any fees, we call it no load fund. They do not charge any fees. But they are generally, most of the funds are load funds. There's a front load, not the washing machine, but the front load charges, where they will charge you the front load when you enter into the fund. There's a back load. They will charge you the fees when you redeem the funds. And they will charge you the fees when you are in the fund. So entry time, there's a fees. When you're in the fund, there's a fees. When you're getting out of the fund, there's a fees. And guys, that reminds me like a very real example of like how the Indian mutual funds were like 15 years back. So the first investment I made into Indian equity market was right at the bottom of 2008. Or don't think like, I got the markets right. It's just that, this was my first job of employment. And वो होता ना like उस time 1 lakh रुपया होता था. If you put money 1 lakh rupees into stock market or invest somewhere, you get the deduction for your income tax purpose. So that's the whole reason I invested 1 lakh rupees in the stock market. And I still remember that time like Sensex used to be like around 6,000. There'll be 70,000, like 10 times. It used to be like 6,000, 7,000, not 6,000, maybe 8,000. 8,000 maybe, yeah. I invested in the next 1 lakh rupees again when the markets were very low. Maybe the Sensex was around 10,000. And I put another 1 lakh rupees into the markets in 2010 when the markets recovered to 13,000. And guys, I stopped investing after that. So if I look back, it seems like, like I timed the market very well. The markets were at the bottom for those 3 years. I put my money and but it's just like a pure coincidence because that plan was a ULIP plan. It was called unit linked insurance plan. And in this case, there was a thing that if you put money for 3 years, it's a minimum thing, like you to invest money for 3 years. Though the plan is for 20 years, but minimum you have to invest money for 3 years. Otherwise, there will be lots of penalties and fees and other charges. So once I was done for 3 years, I did not want to invest more money. And I remember that, I went in 2015 around, and that time the markets were around 17,000, 18,000 points to redeem the money. Now tell me if I'm wrong, guys, but if I'd invested the first 1 lakh when the markets were 8,000, this money should have become more than double. Like maybe 2.2 lakh. I can do the calculation. 1 lakh into 18,000 divided by 8,000. This 1 lakh should have become 2.25 lakh rupees. This 1 lakh should have become 1.8 lakh rupees. And this 13,000, like this 1 lakh should have become 1.39 lakh rupees, right? So my total funds should have become 5.43 lakh rupees. Very basic, right? So I remember me going to this, office and telling them that, hey, I want to redeem my funds. Then they said a number, I still remember very, very clearly. They told me, sir, like, yes, we are going to give you like 3.1, sorry, not 3.1, 3.68 lakh rupees. I said, dude, wait a minute. If I do a basic calculation, it should be like around 5.5 lakh rupees. Why are you giving 3.68 lakh rupees? Then I had to pay some fees to get the detailed statement, which they don't give otherwise. And in the detailed statement, I came to know that the first time when you invest your money, there's a front load charges. So one of my very good friends sold it to me, saying that it's a very nice scheme. But it seems like the first 1 lakh rupees when you pay, the entire 1 lakh rupees does not get invested. Only 40,000 gets invested, guys. The remaining 60,000 rupees goes in the form of commission, fees, and other charges. So I said, okay, even if you make it 0.4, still I should get 4.08, right? They said, no, sir. Then there are other fees what we charge throughout the period. So every year they were charging like 10,000, 15,000 rupees. And not my portfolio is in crores. My portfolio is like 3 lakh rupees. They're charging me like 3%, 4% as a management fees. I said, like, I got very frustrated. They said, why are you frustrated, sir? Like you invested 3 lakh rupees, you're getting 3.68 lakh rupees, you should be happy. I said, yeah, I'm just like very greedy. I'm just not happy. But then I said, okay, give me the money. I want to get out of here. Then they said, okay, sir, sign the paper. And when I was trying to sign the paper, I saw the amount which was like around 3.19 lakh rupees. I said, dude, like you said 3.68, right? Well, yeah, that's your fund value. But because the maturity is 20 years, if you withdraw it now, there's an exit load. I said, okay, if I don't withdraw it this year, if I withdraw it next year, what will be the exit load? Well, abhi we are charging you whatever, like 49,000 rupees. If you withdraw it next year, we'll charge you 47,000 rupees. If you withdraw after 20 years, then it'll become zero. So that was the state of things, guys, like 15, 20 years back. And then rather than investing into ULIP, you should have invested into these companies itself, which were selling the ULIPs. But now, like, thank God, like things have like, cleaned up a lot. And Indian governments and regulators have worked really hard that this kind of scam is not happening in the market. So think about, I invested 3 lakh rupees, I got 3 lakh rupees, even when the market's more than doubled. And this is true, like, any which ways. So now I think you got an idea what are no load funds and what kind of different loads can be there, an entry load and exit load and the management fees when you are invested. Closed end funds, they don't allow you to get in and get out. Once you're invested, there's a lock-in period. And the reason there's a lock-in period is because the fund has invested money into such areas where the fund cannot take the money out. How can they give it back to you as an investor? That's the whole idea. There could be different types of mutual funds. One is money market fund. The minute you hear the word money market, you're investing money for a very short term period and into debt. There could be a bond mutual fund investing money into bonds. There could be a stock mutual funds investing money into equities. Within that, it could be passive versus active. There's an ETF, which we must have talked about in alternative investments, like how the mutual funds are different from ETFs. And then there's a separately managed accounts. Again, we would have talked about it in alternative investment. But in case of separately managed account, if I go to a mutual fund, they'll simply put the money in. They do not consider me as an individual investor. They consider me as just like any other investor. As a result, they invest my money in exactly where they invest others' money into. But in case of a separately managed account, they will think about what are my priorities, what are my risk and return expectations and everything. And based on that, they invest my money into. Then we have got a hedge fund, which is also pooled investment. But the point here is that the hedge funds, any idea, guys, what's the difference between hedge fund and a mutual fund? Which one is more risky? I think we did this in alternative investment class as well, right?
Hedge funds are more risky.
And still we call them hedge funds. Hedging means like you're reducing your risk, right? And you're telling me that the hedge funds are more risky. Very counterintuitive. So guys, hedge funds, the reason they're called hedge funds does not mean they have to hedge. They may or they may not hedge. Then why do we call them a hedge fund? The first fund which was created in this particular format used hedging as a strategy. So that's the reason we call them hedge fund. But there's no guarantee that all the funds in that area will hedge the returns. But the main difference between a mutual fund and a hedge fund is that hedge funds are not as regulated as mutual funds are. So when the things are not regulated, you go a bit crazy, right? I remember my schedule and the time I used to sleep and my habits when I was with my parents till my 10th class. I never smoked. I was like in my bed by 11. I used to get up at 7. And then I went into hostel from 11th. I was still regulated by my warden, by my teachers, but it was not, they were not as strict as my parents. And then the smoking and the drinking, playing, like all the video games, everything started. So that's the thing, guys. You go a bit crazy. The returns are also higher for hedge funds, but the risk is also higher. Private equity, venture capital, all of these guys we have discussed in alternative investment if you already attended the class. If not, you'll do like a detailed discussion around these when you get into alternative investment. So that was a bit of theory. The next topic is about the basics of portfolio planning and construction. So the first step, the planning step, where you create an investment policy statement. Okay? So when I talk about an investment policy statement, I'm going to take lots of details, right? Now, I'll tell you like what kind of details I'm going to take from you and why I'm going to take those details from you, right? So the basic thing is like your name and the contact number and the email ID and the phone numbers. That's like very, very customary because I need to be in contact with you, in touch with you. I'm going to ask you your age, your family background, your financials. Like I'm going to ask you a lot of things on financials, like how much you earn, how much you spend, where you spend, how do you get money from, who all are who all are dependent on you, everything. I'm going to ask you lots of like aspirational thing, okay, like what you want to do with your money, what's your 10-year goal, not in life with your but with your money, what's your financial goals and everything. Then I'm going to ask you, and this is the question I still remember during my portfolio management in level 3. And maybe I'll cover it once we go a bit later, but I'm going to ask you for the circumstance, like, okay, if you have got, let's say 10 crore rupees, how did you get that 10 crore rupees? That's very important, guys, right? If it's your hard-earned money, trust me, your risk appetite is going to be very, very less. But if that's 10 crore rupees you got in your inheritance, you will be a bit more casual and bit more, your risk appetite will be a lot more in that case. So there's a difference in between you being born rich and becoming rich. If you're born rich, like maybe you'll be a bit more casual, but if you become rich, then it's a different ball game. Now, guys, these all things go into consideration for a portfolio manager to decide what's your behavior going to be, how you're going to react, how you're going to behave, and everything. We are going to have a lot of discussion around it as we go further. So this is the main component of an IPS, the description of client circumstances, situation, and the investment objectives. The statement of the purpose. When you apply for a foreign university, you have to write a statement of the purpose, SOP. Here also there's a statement of purpose, like what's your goal? What's your end goal? What you want to do? What money is for you, right? Like your goal could be that, you want to have a luxurious life. Your goal could be that you want to have a good retirement. It could be that, you want to do something for your kids. It could be anything, right? The duties and responsibilities. And I'm not just talking about your social duties and responsibilities, but the financial duties and the responsibilities. Procedure to update IPS. Now, what is your status today may not be the same after 2 years down the line, right? So let's say when you came to me, your total wealth was just like 50 lakh rupees. But between today and the next 6 months, you get a huge inheritance from one of your relatives worth 50 crore rupees. Whatever IPS I had like 6 months back is useless, right? So I have to keep updating the IPS for your revised income, for your revised expenses. So generally there's a requirement to update IPS once in a year at least. Your investment objectives I talked about and the investment constraints. So there's a lot of discussion about what are the objectives, what are the constraints, which we are going to do in a bit of time. Okay, so let's talk about the objectives and the constraint. So objectives, these are the two things what any investor is looking for. One is return, the other one is risk. Very basic, right? That you're looking for a return as well as a risk. Give me 1 second, guys. Now return part, guys, we have had lots of discussion around already. So when I say return, as a portfolio manager, I should be very clear that what's the return you want. And this is, I think we've discussed in the past, that if I ask you in an Indian context, if you put money into stock market, typical returns could be around 12, 13%. But if you ask an investor as a client, how much return you want, they want a 20% return. But the risk, no, they don't want to take any risk. This is problem number one. That when I say return and risk being objectives, the objective for an investor is to maximize return. And the another objective is to have a minimize risk. So these are the two key objectives for an investor. Maximize return while minimizing risk. But can you do both? No. So as a result, the proper objective should be for same level of for a similar return, you want to take a lower risk. So this is what I'll call as a minimize risk. You cannot increase your return and minimize risk both. So the returns are same, you want to minimize your risk, or you want to maximize return for a similar level of risk. So the risk is same, you want to maximize your return. Or for a similar return, you want to minimize your risk. But the problem is that the investor wants to maximize return as well as minimize risk at the exact same time. वो हो नहीं पाता है, and this becomes a very big problem between the portfolio manager and the investors. May I request all of you to please switch on your cameras again? I have to keep giving 10 minutes reminder. The risk objective can be an absolute risk objective or a relative risk objective. What is an absolute risk objective? Hey, I should not lose more than 5% of my portfolio is an absolute risk objective. But relative risk objective is if the market is losing X%, I should not lose more than this much than what the market is losing. So the market lose 20%, I can lose 25%. If the market lose 10%, I cannot lose more than 15%. So it's related to the market. And this is what we call as relative risk objectives. The return objectives can also be absolute as well as relative. Absolute means I want a 15% return. Relative means I want 2% more than the market or 3% more than the market. Now, this is broadly what we know about the returns and the risk. And I think at one place we discussed about when we talk about return, you should pre-clarify whether it's pre-tax or post-tax, whether it's gross return or the net return. The net return is excluding fees, like after deducting all the fees. And is it nominal return or a real return? So what is the difference between nominal and real? The difference is because of the inflation. What is the difference between gross return and the net return? The difference is because of all the fees and the charges. And what's the difference between the pre-tax and post-tax? That's like obvious. The difference is tax. So you have to clarify whether the returns we are talking about, is it a normal gross pre-tax return? Or is it real? Is it net? Or is it a post-tax return? On the risk part, guys, is something we are going to do lots of work on. Okay? We are going to divide the risk into two components. One is ability to take risk, and the willingness to take risk. The first question the portfolio manager will ask you is, "Arey yaar, okay, tell me what is your risk appetite?" And it's similar to a doctor. You go to a doctor because you're not keeping well, and the doctor asking you, "What's your disease?" Whether it's bacterial or like viral. You can tell the doctor, right, "Dude, if I knew it, I would not have come to you," right? So portfolio manager asking you what's your risk appetite is a similar question. If you knew it, you would have managed your portfolio by yourself. And guys, it's not very clear to the investors what the risk appetite is. And I'm not sure whether I've given you these examples before, but I've seen lots of smart people. You think that they should take lot of risk, but they don't take risk in their lives. Did I tell you like about one of my managers, my senior colleague, him and his wife together making like 4 crore rupees per year, and they invest money only into fixed income, and that too in government bonds. They don't want to take any risk. And then there's a friend of mine who's making 15 lakh rupees. Is a family of 6 in Bangalore. 15 lakh rupees, guys, is too less for a family of 6, fully grown up. So he keeps asking me, which stock can he buy in the derivatives market? So that's the difference. So we are going to divide the risk into two components. One is ability to take risk, that how much risk you can take. And the second component is the willingness to take risk, that how much risk you want to take. How much risk you can take? Leave it to me as a portfolio manager. I'll ask you 5 questions. I know how much risk you can take. For example, let's say I ask one of you, you tell me that your income is equal to 5 lakh rupees per month. Your expenses are equal to 1.5 lakh rupees per month. And then your wealth you have is equal to 10 crore rupees. You don't have any dependents. Dude, your ability to take risk is very, very high. You're making lots of extra funds every month. You got lots of wealth and you don't have any dependence per se. So you can take lots of risk in the market. Your ability to take risk is very, very high. But let's say if I ask the second person, the income being 1 lakh, expenses being 90,000, which is 0.9 lakh, wealth 15 lakh, and the 3 dependents, I would say the ability to take risk is very, very low. So I think the ability to take risk is more of a science rather than an art. And as a portfolio manager, I'm there to tell you what's your ability to take risk. Maybe I can have a formula behind it. I can have a structure behind it that if I ask you 5 or 7 questions, I exactly have a very clear idea about the ability to take risk. But the problem comes when we start talking about the willingness to take risk. Don't tell me, but ask yourself a question. Do you know your willingness to take risk? And you paying Dream 11 doesn't mean that you can take risk unless you're making a team costing like 1 lakh or couple of lakh rupees. वो 100 rupees का team बनाने से वो risk नहीं है. Or you playing that Tombola game is not a risk. Have you taken a large risk in life? So let's do this like a real life thing. I can, try to figure out what's the willingness to take risk. Any volunteers? Yeah, there will be some personal questions. but I'll make sure that I don't ask you any very, very sensitive personal questions. And I can tell you what's your willingness to take risk is.
I can volunteer, sir.
You? Okay. So
Sir,
let's
I will.
go. Okay, let's go with Samay. The first come, first serve. Okay, Samay. So tell me a bit about like what do you do, how your typical week is in terms of schedule.
So I have a 4-day work week. So I
Okay,
work
where do you work?
in a financial planning firm. It's an investment advisory.
Okay, so you are full-time salaried employees,
Yes. Yes.
and this is your first job.
Yes.
Okay, and how do you go to office? How do you come back?
Local trains, Mumbai.
Oh, sorry. So you don't have a choice, right? Local trains. Like
Yeah.
otherwise, if you take your own vehicle, it's going to take you a lot longer. What do you do on weekends?
CFA and studying. Yeah. Mainly studying
CFA and
and
studies.
outings with friends and some
Sorry, outing.
outings with friends and all like dinners, etc.
Okay. What do you mean by outing? Like what exactly you do with your friends when you're on an outing?
So we most probably go to eat somewhere or maybe some activity like bowling or stuff like that.
Okay. What's the most crazy thing you've done?
Most crazy thing. So in terms of everyday thing or it may be once in a while
Once
thing.
in a while.
Skydiving.
Oh wow. Somebody forced you into it, or it was like you planned for it and went for it and everything?
No, I wanted to do that.
Okay, understood. What are your other hobbies?
I like to go on drives.
Like, what's your
I
definition of a drive? Like, nice natural beauty around and you just like driving, peacefully, or it's like a highway and you're going at a
yes, correct.
150 speed.
I just don't like traffic. Except for that,
Oh, nobody
anything is
likes
good.
it. Don't state the obvious. But what's your like,
But
what will be your like best driving experience be? What's your dream?
highways, definitely.
Sorry, your voice is breaking somewhere.
Dream would be the German autobahn. Can you hear me?
Yeah, German auto,
The autobahn highway with no speed limit and rent a good
that
supercar over there.
supercar. Okay, cool. I think I'm done. What do you think, guys? What do you think his willingness to take risk is?
Yes, according to speediness of the mindset, he can take the risk.
So, like to be honest, when I started, like, salaried, CFA, eating out. It's not drinking out, it's eating out. I was getting a feel that, maybe he's towards the lower willingness to take risk. And then he started talking all of a sudden skydiving, supercars, no speed limit. So I would go with that. His willingness to take risk is high. So, guys, this is an art. Though like given the like the time constant we had, I couldn't ask him more questions. But I'll keep asking him more and more questions. I'll keep getting into more details and keep getting into more follow-up questions before I make a decision that okay, willingness to take risk is high or low. And this reminds me of one of the questions during my level 3 exam. They give like a one-page bio of a particular investor. Like this is his financials, this is what he does, this is like what his family is all about, this is what he enjoys and everything. And I thought like, this will be a question about like, the risk, ability to take risk. But no, the question was about willingness to take risk. When it's about willingness to take risk, the salaries and the incomes are not relevant at all. This is your behavior, this is your personality, right? And at that point of time, I thought, okay, like 70% of the information given in the biography, like, the financials and everything is useless because the question is not about the ability, the question is about willingness. And guys, even those qualitative non-financial information were very, very generic. He has got 3 kids, he lives in this particular avenue in New York, in this city, that state, has been doing a job from so many years, blah, blah, blah. But there was a statement like, he goes skydiving over the weekends. Because of that, you can conclude that he has a higher willingness to take risk. Okay? So ability to take risk is like scientific, you can easily find it out. Willingness is an art, and nobody knows what their willingness is. So as a result, the portfolio manager can ask few relevant questions to get to the willingness about the people. Now, in this case, that brings us to a very interesting point that there could be different permutation and combinations about the ability to take risk and the willingness to take risk. What do I mean by that? Just hold on. So let's say there could be a client whose ability to take risk is low and the willingness to take risk is also low. That this could be like a case one. Case two could be the ability to take risk is high, the willingness to take risk is also high. Case three is ability to take risk is low, the willingness to take risk is very, very high. And there could be a case four where the ability to take risk is high, but the willingness to take risk is low. These are the four permutation combinations possible, right? If the ability to take risk is low, the willingness to take risk is low, as a portfolio manager, my final conclusion would be that I'll take a low risk on your portfolio because the risk you can take is low, the risk you want to take is low. As a result, I'm going to take a lower risk. If your ability is high and the willingness is high, I'm going to take a higher risk. Now, if you ask me that if there are 100 investors, I'm going to manage people, I'm going to manage 100 investors' money. Out of them, how many people will be there in case one and case two? If I look at India's population, maybe 5 people here out of 100, 1 person here, 20 people here, but the vast majority, whatever left, is here. And guys, as a portfolio manager, I don't get paid to manage case one and case two. They're very straightforward. The main pain is to manage these 95% of the people, right? Now, what do you do with case three when the ability is low and the willingness is high? Do you take a lower risk or a higher risk? So generally the conclusion is that you take the lower of the two. So if either the ability or willingness is low, you take a lower risk. But the problem here is try to put yourself in that shoe. You come to me, your ability is very, very low, looking at your financial background, looking at your income and expenses and everything. But your willingness is to take a very, very high risk. And you come with your money to me and I park your money into fixed deposits. What you want to do is you want to invest into private equities and hedge funds. And what am I doing with your money? I'm investing your money into fixed deposits. Are you happy? There'll be lots of friction between you as my client and me as a portfolio manager. Right? So in this case, guys, what you do is it's always better that you align ability and willingness and you educate, you have lots of counseling sessions with the investor so that both of these can be aligned. How can you align it? Either increase the ability or reduce the willingness. How can you increase the ability? As a portfolio manager, you have got lots of money, donate some money to this person, his ability will go up. But that's very, very, uh, like very, it's not an idealistic scenario, right? So what we are saying is that ability is something you cannot do anything with. So what I'll do in this case is I'll try to reduce willingness to bring it down towards ability. So maybe I'll try to counsel the investor, hey dude, like, you should not be taking this much risk, and see what will happen if you lose this much money. You won't have money for bread and butter. You cannot afford it. And I'll give him lots of examples and suggestions to reduce the willingness towards low. So there could be two scenarios. I'm successful in making it low. Then the risk I'm taking is the lower of these two, which is low risk. But let's say if I'm not able to convince him, he still wants to take a high risk. What I'm going to eventually take is still a low risk. So whether I'm able to convince the client or not to reduce the willingness towards low or not, my final conclusion would be that I'm going to take a lower risk on that client. But still, it's important that I spend the time and effort to educate and counsel the client, because if I'm not able to convince the client with his willingness still being high and the ability being low, I'm investing his money into low risk investments. But given his willingness is still high, the friction will be very, very high in this case. As a result, the better scenario is I'm able to convince him, and then he and me are on the same page. Case number 4, ability is high and the willingness is low. Can you reduce the ability towards willingness? Can you reduce the ability? Yes, you can do that. Steal money from your investor. Rob him of all his funds. Ability will come down. Oh, but we won't do it as an ethical portfolio manager. So you can't do anything with ability. It's about willingness should be increased. You should educate the investor that he can take more risk. You can give him lots of scenarios that even if this goes wrong, you will still be left with this much money. I'm not saying you're provoking. Provoking is a wrong word. Educating the client to take more risk. If you're able to convince, this will also become high, and you'll take the lower of these two. High and high, the lower is still high. But for some reason, if you're not able to convince, then you'll take a lower risk. So guys, in case 3, whether you're able to convince or not, your conclusion will be same. But in case 4, if you're able to convince, you'll take a high risk. If you're not able to convince, you'll take a low risk. So this is a discussion about ability to take risk and willingness to take risk. And when we say that whether you'll take a lower risk on the portfolio or the high risk on the portfolio, I'm not talking about the ability. I'm not talking about the willingness. I'm talking about the final conclusion, which is a mix of both ability and willingness, which is the lower of the two. I'll stop here for a few seconds. Let me know any questions, any thoughts, any reactions. All clear? Okay. So let's go further. So this is what I was talking about: ability to take risk and willingness to take risk. Willingness to take risk is based primarily on the investor's attitudes and beliefs about investment. The assessment of an investor's attitude about risk is quite subjective and is sometimes done with a short questionnaire that attempts to categorize the investor's risk aversion or a risk tolerance. But the ability to take risk is a bit more scientific. तो अगर मेरे को समय का पता करना होता, what is the ability to take risk, my questions will be very different, right? My question would be how old you are, Samay. The minute he says 22-year-old, I'll say the ability to take risk is high. Then I'll ask him his income and the expenses and the wealth, and I'll get my answer. So see, the ability to take risk depends on financial circumstances, longer investment horizon, greater asset versus liabilities like more wealth, more insurance against unexpected occurrence, and a secure job. This all suggests a greater ability to take risk. So there are two different things. One is ability, the other one being willingness. In situation where ability is high but willingness is low, the advisor may attempt to educate the investor about investment risk and correct any misconceptions. Right? So ability is high, but the willingness is low. So I have to increase the willingness towards ability. So guys, these are the objectives, risk and return. Now we come to the constraints. So risk and return are the two key objectives. But as a portfolio manager, I have to get you that risk and return objectives while meeting these constraints or these limitations. What are those constraints? There are 5 constraints. One is liquidity. The second is legal. The third one is tax. The fourth one is time horizon. And the fifth is a unique circumstances. So guys, some people call it there are two risks, there are two objectives. One is return and risk. And there are 5 constants, which is liquidity, legal, time, tax, and unique circumstances. So they use this, and sorry. So they call this scenario to be RRTTLLU. Just like a way to remember, RR are the objectives, TTLLU are the constraints. So we already had a discussion about the objectives, but let's talk about the constraints. So let's say there's a particular investor who wants a return of, let's say, 15%. And you looked at the willingness to take risk, you look at the ability to take risk, and this person can take a total risk of, let's say, the standard deviation of 9%. And with the standard deviation of 9%, the minimum variance portfolio or the optimum portfolio or the capital allocation line will give him the total return of 15%. Okay? Let's say there's a person who is 20-year-old and he needs this money for his retirement, which is 50 years later. And the total fund size is 10 crore rupees. So guys, if I tell you that why the fund size is important, let's say you can invest your money into government bonds. If you invest your money into government bonds, maybe you'll get a 6% return. You can invest money into corporate bonds, depending on AAA, AA, or whatever, you get 8% return. You can invest money into equity market. If you invest money into large cap, you get maybe 10%. If you invest money into small cap, you get more, maybe 13%. But you can also invest money into private equities. You can get 18%. You can put money into hedge funds. You can get 20%. You can invest money into VCs. You can get 25%. You see? But the problem here is that if you want to get into private equity, hedge funds, venture capital, you need a ticket size of at least a few crore rupees, right? You cannot do that with a small money. And also your investment horizon should be long. You cannot make money in private equity and all within 2 years, because the lock-in period itself will be like 3 to 5 years. So you want an investment horizon which is long enough. So looking at this person who's a 20-year-old and the fund size is, let's say, 10 crore rupees. As a portfolio manager, I get lots of comfort. Yeah, 15% return to आराम से बना लेंगे, because I can put some of his money into private equity, hedge funds, and VCs, where I'm getting close to 20% return. And I'll park some of his money into equity market, where I'm getting 12% return. So on an average, I can get 15% return आराम से. But let's say rather than 20-year-old, what if this person is 65-year-old? These things go, like you cannot invest into these things because this requires a long-term horizon, right? So guys, time horizon is a very big constraint. And if you're an old person or your investment horizon is shorter, that reduces the investment avenues where you can park your money and the risk you can take. And for this person, if you're 65-year-old, forget about this. You cannot invest money into large cap and small cap as well. The reason being that if there's a decline in the stock markets, because your investment horizon is so small, you cannot wait for the recovery for the market. As a result, only thing and everything you can invest into is government bonds and the corporate bonds. And by investing into government bonds and the corporate bonds, can you get a 15% return? No. So guys, time horizon is one of the largest, the biggest, and the most significant constraint. So if you're 20-year-old with 100 crore rupees, everything is open for you. But if you're a 70-year-old with a 20 lakh rupees in your pocket, only thing you can do is government bonds. The second one is a tax. Let's say I want a 15% return, which is a post-tax return, as it's obviously, and I'm in a high income tax bracket where I'm paying 35% taxes. So if I want a 15% return post-tax, on a pre-tax basis, I should get how much? On a pre-tax basis, I should get 23% return. Now, in this case, in all these cases, they'll give me 20%, 18%, and 13%. But the problem is this is pre-tax, and post-tax, they will be less than 15% return. See, I'll calculate the post-tax, this into 1 minus 35%. On a post-tax basis, this is only 3.9%, 5.2. Even if I go to the higher one, this is only 11.7. This is only 13%. And even this is just crossing that 15%, 16.3%. But let's say if I'm in a 0% tax bracket, it's easy to achieve the same 15% return because my taxes are lesser. So this is another big constant, that for the clients who are paying a huge tax or into high tax bracket, it becomes even more difficult to get them a 15% post-tax return. The third major constraint is liquidity. Let's say this person comes to me who is 20-year-old with a fund size of 10 crore rupees and wants a return of 15%. I think, हाँ यार, ये तो आराम से कर देंगे. Like, I can always invest money everywhere. All the avenues are open because this person is young and the ticket size is pretty large. But what if this person says that, hey, out of this 10 crore rupees, I need 7 crore rupees after 2 years for buying a commercial building for my own business. So out of 10 crore rupees, only 3 crore rupees I can invest into long-term things, because 7 crore rupees has to be parked in such a way that I can withdraw it anytime in the next 2 years. So here, liquidity requirement is a big constraint. So though the fund size is pretty big, but out of the 10 crore rupees, he may need 7 crore rupees any point of time. So I cannot put this 7 crore rupees into large cap, small cap, PE, hedge funds, and venture capital, because I should be ready to withdraw this money as and when required. The fourth constant is legal. This legal constants are a lot more if you're managing mutual funds and the hedge funds, sorry, mutual funds. There could be a requirement that, hey, you cannot put more than 10% money in a single stock. You cannot do short sell. You cannot take any leverage. So those kind of constraints, which are legal. And finally, the unique circumstances, guys, as the name suggests, they are very, very unique. They could be very random to the individuals. Like one of the individuals can say, you know what, my ex name is starting with S, so I don't want to invest into any company which has a initial S into it. I don't like smoking, so I don't want to invest into any companies which are into tobacco. My name starts with A, so I want to prefer the companies who has a alphabet A in their names. It can be anything. So this is what we call as unique circumstances. So this is the balancing act, right? The portfolio manager has to get this risk and this return while managing these constraints. So there are two objectives and there are 5 constraints.
So, hello, sir.
Yeah, tell me.
Yes, sir. According to you, how should we set the return, sir? According to you, so any individual, let's say, one individual client is there, sir.
Mhm.
So he either we accept his expectation, or how we should go forward.
So generally,
Initial,
you start with the risk actually. You ability, as I said, is very easy to identify.
yes, sir.
Then you get into the willingness. So you know what is the total risk thing, whether
Okay,
it's low or high. If the
okay,
risk is low, obviously you should
okay.
expect a lower return. If risk is high, you can expect a higher return. But getting into numbers is not easy, right? So maybe in
Yes,
case of India, I would say that the typical standard deviation is around 8 to 9%, and the market is giving you 13% return, right?
okay.
So if somebody looking at the willingness and the ability, if you think that the person can take a lower risk, but within lower risk, there's a different degree of lower risk, right? कई होते हैं भाई मेरे को मतलब I don't want to invest money even in corporate bonds. Forget about anything else.
Mhm.
So in that case, the risk appetite is very, very less. It's just not low, it's very low. Then it's very difficult to put a number to it. But let's say if I put a number 5% to it, because the
Okay.
risk appetite is very low, the returns will also be lower. I don't know, maybe 9%. But if it's just low, like it's not as low as 5%, but not as high as 9%, it's just like medium, maybe let's say around 7.5%, then you can expect a return, which is also somewhere in between, maybe 11% return. But this is neither a part of your syllabus nor is an like that easy exercise. तुम ये prorata नहीं कर सकते. There's lots of work goes behind it. Okay, so these are the 5 constants: liquidity, time horizon, taxation, legal, and the unique circumstances. I'll stop here, guys. If you got any other questions, and request all of you to please switch on your cameras. तो एग्जाम में से एक बार क्वेश्चन था कि the purpose of the fund was to finance one of the surgeries. So let's say, this is a person collecting funds or managing funds, and the objective of the fund is to finance the surgery for its spouse. which is a very critical surgery which has to be done at the end of 1 year. Now, guys, the sensitivity to this fund is so important that you cannot afford to lose. Because if you increase the fund size, what will happen? Will you ask the doctor to do a couple of more surgeries? No. So in that case, the wealth preservation is the main criteria. So there could be two objectives. One is wealth preservation, or it could be wealth maximization. In case of wealth preservation, your main focus is that it should not go below the current levels. If it goes up, it's fine. If it doesn't go up, it's fine. But the main focus is that it should not go below these levels. So at the end of 2 years, if you tell me that there's no growth, that's fine. But it should not go below the current levels. That's the main thing. But in case of wealth maximization, your focus is like to how much you can increase the wealth. If it goes in the process, it can go down, that's fine. But my focus is that how much up it can go. Okay? So guys, there's a thing called strategic asset allocation that once you look at the risk, you look at the returns, you look at the constants, then based on that, you decide that, okay, how you are going to put money across different asset classes. This is a strategic asset allocation because you're not deciding what you're going to invest into. You're doing very, very broad. So yeah, let's say maybe for this investor, let's put 40% money into corporate bonds, 20% money into government bonds, and 20% money into large caps, and maybe 10% money into alternative investments. So this is a strategic asset allocation. You're deciding very broadly how you want to allocate funds across different asset classes. Now, once you decided the strategic asset allocation, then within equity, which equity to buy, how much you invest into particular sector, how much you invest into particular company, those things you're trying to decide. So see, this is the strategic asset allocation. You decide which all broad categories you want to invest your money into.
Sir, is there any ratio or how we'll decide, sir?
या देखो यहाँ पे अगर रेशियो या कोई प्रोग्राम होता then you don't need a portfolio manager. सब कुछ robo advisors बन जाते, right? So yes, in
Okay.
some cases we use robo advisors, but it's an art. And we divided the risk and return only in two categories, right? Low and high. But
Low
it
and
can be
high.
very low, it can be low, it can be moderately low. So it's just not like it's not binary, right?
Okay. तो बेसिकली हम लोग कुछ कैलकुलेशंस कर लेते हैं अकॉर्डिंग टू आवर नॉलेज एंड जो भी रहेगा तो उसके हिसाब से रिटर्न एंड रिस्क को प्रेडिक्शन करके हम लोग असेट क्लास डिटरमाइन करते हैं.
Right, exactly.
Okay.
And see, one thing is it depends on the investor's risk and return requirement. It also
Yes.
depends on what the market conditions are.
हाँ.
What do you think about the market conditions, right? तो अगर तुम्हें लग रहा है कि the markets are going to go down, you want to park more money into bonds. If you think markets are going to go up, you want to park more money into equities. Cyclical लेना है, non-cyclical लेना है, which fund to invest money into. All of these things will come under consideration.
Whenever we work with this kind of data, the data will be huge, sir. I mean, data will be huge, and the collection of sample data, stocks, multiple asset, वगैरह वगैरह वगैरह. So, is there any applications or how it will work? Do you
Yeah,
have
यहाँ
any?
पे data will not be too much. You getting my point? Like you're just looking at an individual. अच्छा, see, first of all, as a portfolio manager, I'm not going to manage like thousands of clients.
Okay.
It's impossible, right? मतलब 1,000 लोगों को तुम IPS मतलब even if you have the recorded IPS, how will you look into those IPS? So typical span is that you have like 50, 70, 80 clients.
Hmm.
As a mutual fund, I can have multiple clients, but they park your money without looking at your risk and return requirement. But if it's a separately managed account, I'm going to look at your risk and your return and park your money. It will be just 50, 60, 70 clients. So उससे ऊपर तुम कर ही नहीं सकते.
Okay.
So in that case, the data is not much. It's just about the subjectivity, the gut feel, and those kind of things.
और सर हम लोग एक दूसरे का वो एथिक्स में शायद नहीं है ना सर कि एक का प्रॉफिट रेशियो दूसरे क्लाइंट के साथ मिक्सअप करना, उसका कॉपी
पोर्टफोलियोज का वो गैप अपन ने उसमें जिप्स में पढ़ा था, ग्लोबल इन्वेस्टमेंट परफॉर्मेंस स्टैंडर्ड्स,
हाँ
उससे मिक्स मत करो, बट हाँ मतलब दैट्स लाइक अ डिफरेंट थिंग ऑल टुगेदर, हाउ यू प्रेजेंट योर परफॉर्मेंस.
present.
Now, when we talk about a strategic asset allocation, कई लोग क्या करते हैं, they are passive. They simply put the money in the exact categories where the main fund is invested into. जैसे Nifty 50 is invested into 20% banking, 15% tech, 10% metals and mining. This is what the portfolio manager will also do. This is what we call as passive allocation. But some portfolio manager will say, hey, I want to increase the investment into the banking sector because this is something which is going to do better. So though banking sector is 20% in the entire index, I want to put 25% into it. And I want to put less money into chemical sector because that may not go up a lot. So what you're doing is you're keeping the exact same index, but you're increasing the weightage of one of the sectors and reducing the weightage of the other sector. So this is what we call as tactical asset allocation. But somebody might do a security selection. They do not just change the weightage of the categories, but within each category, they'll say, अच्छा बैंक के अंदर index के अंदर it's HDFC and ICICI Bank, but I don't want to invest money into HDFC Bank and ICICI Bank. I want to put money into IDBI Bank and the Canara Bank. So this is what we call as security selection. Now, generally, there's a thing called risk budgeting. What is the risk budgeting? Just like we budget for our monthly expenses, somebody might budget for risk as well. What will we do for the monthly budget when it comes to expenses? Arey yaar, theek hai, I've got 20,000 rupees to spend money on. I'll pay 7,000 rupees on rent. I'll pay 3,000 rupees for my food. I'll pay 2,000 rupees for my travel. I'll pay 3,000 rupees for my eating out, entertainment and stuff. And then I'm left with 2,000 rupees, which is good enough for my contingency, right? In case I fall ill, in case I've got some visitors, in case I've got some guests. For those purposes, I need this 2,000 rupees. This is what like a typical plan would be, right? Or budgeting would be. In case of risk, a similar budget will happen. Acha, the total risk I can take is X%. So if I invest into this, out of 100 crore rupees ka risk I can take, 30 crore rupees ka risk is coming from here, 10 crore risk is coming here, and blah, blah, blah. So you're dividing your risk across categories and making sure that your overall risk is within your control or within your comfort level. A practice known as risk budgeting sets an overall risk limit of, let's say, 100 crore rupees for the portfolio and allocates the portion across different categories. We already discussed about who the active portfolio manager is. An investor may have multiple managers actively managing the same benchmark for the same asset class. So it means for Nifty 50, there could be different asset managers. Because one asset manager will take 50 shares, but will not invest into 2 shares, will invest into 2 another shares. Some active portfolio manager will not invest enough money into banking, may put some more money into chemicals. So there's different ways. Your starting point is same, those 50 shares. But somebody is just like adding some more color and bias onto those 50 shares. किसने ये 2 हटा के ये 3 ले लिए हैं, किसने ये 2 हटा दिए हैं बट लिया कुछ एक्स्ट्रा नहीं है, किसने 3 एक्स्ट्रा डाल दिया उसके अंदर, किसी ने वेट चेंज कर दिया है, कुछ भी हो सकता है, right? So a same index may have multiple active managers managing the same index in a different manner. Now, there's a core satellite approach, what many people do. What is a core satellite approach, guys? And this is a very good investment advice, I would say, for anybody who's investing money into the market. So this approach is called core and satellite approach. How many of you invest money into the market, by the way?
I
And with your cameras on, guys, I don't know.
Rakesh.
Acha, Rakesh, you invest money? And how do you
Yes.
invest money?
So basically, I work in intraday, so not in long term. Intraday and
Oh,
algo
that's
or
not an investment. That's trading.
Acha, okay, I do trading, so not an investment.
Cool. Anybody else who does like investment? Mutual funds, stocks, debt.
I've just started with mutual funds.
Oh, SIP, mutual funds sahi hai.
Yeah, kind of.
Okay. Don't you come across some people saying, "Arey yaar, buy this stock is doing going to be very good," or you come across by your own research, "Arey yaar, this stock looks good, I want to buy this stock."
Yes, there are.
So in this case, the core satellite approach says that the core, like the passive investment should be 80% of your total investment. But if you have got some different opinion, "Arey yaar, like HDFC Bank is a part of Nifty 50, but there's a stock IDBI Bank, which is not part of Nifty 50 index, but I think it's going to be very, very promising." And there could be other stocks. So you invest 20% of your fund into those stocks, which are not part of the index, which are not part of passive, but you manage actively. So 80% of your portfolio is passive, but 20% of your portfolio is satellite. So उससे क्या होगा? You are getting the, if the markets go up, you're not taking too much risk by deviating away from the passive investment, but you're getting the upside because of your picks. So this is also called as hub and spoke model. So major of your investment is in the hub, and you have got some spokes where you put some extra money. So this is a strategy many investors follow. The core satellite approach invests the majority or the core portion of the portfolio in passively managed indexes and invest a smaller or a satellite portion in active strategies. Now it's 80-20, 90-10, it's up to you, but it cannot be 60-40. Cool. Sorry. Any questions? Somebody was making any comments there. Is this clear, guys? What is core satellite approach?
So can you tell one example for the course? I mean,
Wait, matlab, so you divide your portfolio into two different components. One is the core, the other one is satellite.
okay.
Core is going to be a majority part of your portfolio where you put 80-90% of your money into passive funds. And the satellite part is going to be very, very small, where you put maybe 10 to 20% of your portfolio into something which is actively managed.
And core portfolio is mixture of everything.
But it's more passive. But you don't try to take your own discretion. अगर तुम्हें इंडिया मार्केट में इन्वेस्ट करना है, you simply buy Nifty 50 that way.
Understood.
Satellite is investing into the entire index or only select index constituent funds. So satellite is never investing into the entire index, Aaron. Then it's not a satellite. So let's say my core is that I'm investing into Nifty 50, which covers all the sectors, all the companies. And my satellite could be that I'm investing that extra 10%, 20% over and above Nifty 50. I'm investing that money into chemical index. So that can be sector index because I have more constructive view on the chemical sector in the industry in the country. Or it could be a particular stock, or it could be a combination of stocks. But it cannot be the broader index. Because if your satellite is also invested into the broader index, then it's technically the same as core, right? So core is in the broader index. The satellite can be in a sector index or in a particular stock. Cool. So we'll take a break again. After the break, we'll discuss about the ESG part. We covered it in corporate issuers class as well, if you've done it with me. But I want to spend some time on it, maybe 5-10 minutes before we go to the next topic. Okay, so it's 12:01. Let's be back at 12:20, and then we'll have a session for another hour and a half or so and call it off. See you guys at 12:20.
Sure.
Okay, guys, let's continue. So we'll talk about the ESG investing. This topic is also covered in your corporate issuers, but with a different flavor. It's more about what is E, S, and G is. But what is being covered in your portfolio management is entirely from the portfolio perspective. That what is ESG investing is all about. So when we say ESG investing, the investor is looking into investment. One is like from the risk and return perspective, but they are also looking at what are the ESG scenario for that particular investment. May I request all of you to please switch on your cameras so I know that you guys are back. And guys, will highly appreciate if you just keep your video on rather than me having to remind you every 10 minutes. Thank you, Nandini. And I see that you kept the video on most of the time. Others, can you please do the same? Yeah. So ESG investing is about you trying to invest only in those stocks which are not negative from ESG perspective. So this is what we call as negative screening. That you'll say that, okay, if you're bad from ESG perspective, I'm not going to invest in that particular stock. How many of you did the ESG part in corporate issuers with me? Rakesh, I think you joined late, but others, like I did your corporate issuers topic, right? For most of you.
Yes.
Right. So we took an example within E, like the environmental thing, like all the metals and mining company, they are bad from environmental perspective. But if you're into solar or hydropower, you are positive from environmental perspective. On S, the social part, we said that any company which is not good for the society, it could be your ITC as a company which is into cigarettes or any liquor company, that's social negative. But what will be social positive? Any company which is into education, hospital, all of that are social positive. Governance, we said like, like for example, Tatas are considered to be very good at governance perspective. So initially people thought that we don't want to invest into those companies which are negative from ESG perspective. But now there's a different trend going on, which is they want to invest only in those companies which forget about being negative. They are positive from ESG perspective. And what do you think about, like, tell me your honest thoughts. Let's say if there's a company which is not that great from ESG perspective, but you think that the returns are going to be very, very high, and there's no room for emotions in the portfolio world, right? What do you think you should do? Should you invest into that company? That may not be very good from ESG perspective, that can be bad, but otherwise the returns are going to be very, very good because this company is available very cheap. The valuations are very low. So you can make a significantly high returns by investing into this company. So what should you do as a practical investor? Should you invest or not invest?
Sir, I will invest.
Because what matters is returns. It's very practical. But guys, even if you're a very practical investor, I'm not saying that you should be worried about the environment, science, social, and the governance part. But the problem is that these companies which are negative from ESG perspective, they can incur a very big loss to your portfolio. There have been lots of cases where the companies have been fined more than the value of the company because they violated some environmental, social, and the governance rules. The best example is Enron, that they had a governance issue. The company became bankrupt. Satyam, very good company, solid returns. Overnight, it became bankrupt. Yes Bank, we can take an example of.
Volkswagen also.
Sorry,
Volkswagen.
which one?
Car company Volkswagen, German. They
Okay, okay. So the list is big, right? So, and the fines can be quite significant. It's So even if you're a very, very pragmatic, practical investor, still you should stay away from the companies which could be negative from the ESG perspective. Now, there's a thing called thematic investing. People invest into those themes or those investments which are ESG specific themes. For example, solar as a theme, wind power as a theme. It could be your investing into those stocks which are into recycling as a theme. There are some people investing into impact investing. So again, impact investing means which are promoting ESG practices in the market. Now there's something called active ownership. These people go after the company and push the company management to bring out the changes in their ESG. So we call them activist investors. So guys, one thing is for sure, irrespective whether you are a negative, you're doing a negative screening, positive screening, thematic investing, or whatever it is, there's an increased focus on ESG and people are making it an integral part of their portfolio process. Okay, that brings us to the next topic, which is about the behavioral biases. It's a very, very interesting topic, a very important as well. And by the time you get into level two, it'll become like a full-fledged book. Like there's a whole book on this topic. And it's all about how people behave. Okay, so we'll take lots of examples, lots of stuff. It can be a bit theoretical and you may find it a bit boring, but try to relate with it, try to think of examples, and please feel free to share it so that we have more examples rather than just me giving you examples to further substantiate on the topics. Cool. So let me just open one of the files. Right. So we are going to discuss two types of things, right? One is cognitive errors and the other one is emotional biases. So the entire way the people behave, they can take a wrong decision on the investment process. And this wrong decision could be due to either cognitive errors or the emotional biases. What do we mean by cognitive errors? Cognitive errors is just like the way you analyze stuff, the way you look at the thing, the way you analyze it, the way you process the data, the way you process the information is a cognitive error. Cognitive is like the intellectual error, right? So if I tell you that, hey, take this, don't take the average, take the median. In this case, you should trim the outliers. In this case, you don't do this, you do that. You can rectify those errors, right? So the cognitive errors are the errors which are based on the process or the way you process the data or the information. And these cognitive errors can be corrected once you get an advice from somebody. But the emotional biases, This is how you are wired. This is how you have been operating as a system, as a human being over the years. Can you change that? For example, let's say you are conservative in your approach, and I tell you, hey, become aggressive. That's like not happening. You're conservative, you're conservative. Let's say you're an introvert, and I tell you, you should be an extrovert from tomorrow. It's not possible, right? So the emotional biases are the way you are being wired, the way you have been rooted. Like, this is your core. And can I change the core here? No. So one school of thought says that if you cannot do anything about the emotional biases, why do you even bother about it? Why to discuss? Because nothing can be done, right? Okay, nothing can be done. But being aware of those biases itself is a half battle won. For example, like I know my bias, like maybe the way my upbringing was done, the way, like my family standard of living was not that great in the early childhood. Even if I make lots of money today, but if you ask me to buy something very, very like, can I splurge money today? Maybe not. Now, can I do anything about it? I did once, okay? I still remember that, I was like, I think it was 2011 or 12. And I thought that, dude, if I'm into investment banking, if I'm going to make money, I should know what I'm going to do with this money. I don't want to leave money behind, right? So that my kids are fighting for that wealth. So that was just like a realization one fine day. And that was just after my bonus, like a huge bonus. I thought that if I'm going to work hard, I should use this money. I should consume this money myself. And I told myself that I'm going to splurge money. My behavior is not to spend money on myself, but I thought that I'm going to splurge money. And you know what? I made a plan that I'll just go to Dubai with my friends, with not with them, not with my family, but with friends. And I was there for like 2 or 3 days, like 2.5 days. We stayed like almost like a five-star hotel. And in those 2 days, I think we spent 1 lakh rupees. We did all the crazy things. We got drunk, blah, blah, blah. And it was like too much imposed on myself. But then after that, was I feeling very good about myself? No. I was feeling more guilty that I spent 1 lakh rupees in 2 days rather than feeling good about it. So that's the problem, guys. If you try to impose something which you're not comfortable with in terms of your behavior, is going to, there would be like a counter reaction. It won't be good. You won't be comfortable with yourself, and this doesn't work. Let's say if my risk appetite is not there, if I go outside my behavioral pattern and I try to invest into stock markets, it won't work. So you cannot do anything about it, but just being aware is good, because then you at least know that you're not doing it, but that's your behavior. Otherwise, you should be doing it. Okay? So the cognitive errors can still be corrected. They could still be improved, but the emotional biases, the best thing you can do be aware about it. Yes, if you're very, very strong minded, you can do something about your behavioral or the emotional biases as well. But nobody's expecting you to change your emotional biases. Cool. Now, within cognitive errors, we are going to talk about belief perseverance bias and the processing error bias. These are the two main categories. Within belief perseverance bias, we are going to talk about many more things. And within processing errors, we are going to talk about many more things. And on the emotional bias part, we are going to talk about loss aversion, overconfidence, self-control, status quo, blah, blah, blah. Okay? So there are two main categories I'm going to talk about. One is cognitive error. The other one is being emotional bias. Within cognitive error, I'm going to talk about two main categories. One is belief perseverance and the other one being processing error. but both of them are part of cognitive errors. Both of them is how you process the information, how you process the data. And if I advise you, if I counsel you, if I suggest you few things, you can work on your cognitive errors to improvise on that. But this, the entire emotional bias, this is something you can't do anything about it except being aware of it. So you're going to get into the first category within cognitive errors, which is belief perseverance bias. What is a belief perseverance bias? It's a main discomfort what a human being gets when their belief is being questioned. And I'm not talking about the belief about the humanity or the belief about the society, but the belief about something what they thought about the stock markets or the economy. Let's say Sovic had a belief that the India's economy is going to grow in the next 5 years at a very significant pace. And he's a strong belief into it. Let's say a Wall Street Journal article comes which says that how India's growth may be impacted in the coming years. Sovic come across this article. He will have a big uncomfortable situation because what is his belief in his brains is that India is going to grow, but he sees an article which says that India's economy will be impacted in the next few years. So belief perseverance bias is a mental discomfort that arises when new information conflicts with previously held beliefs or cognitions, also known as cognitive dissonance. You see something which is not consistent with what your current belief is. So what Sovic will do? Sovic will say, "Arey yaar, this Wall Street Journal article must be written by somebody who is against India. This Wall Street Journal article has been written by somebody who is very pessimistic in life. This Wall Street Journal article is not reliable because this is not based on a detailed analysis." He'll find so many excuses just to completely ignore that particular piece of information. But next day morning, he sees something in Times of India, which nobody reads as an economic paper, right? And the Times of India says that how India's economy is going to grow in the next couple of years at a very fast pace. Oh, this is consistent with what Sovic believes. And he'll say, "See, I told you, see, this article talks about the same thing." And guys, you know, right? Like, which is a better paper, like Wall Street Journal versus Times of India. So you keep ignoring something which is against or inconsistent with your belief. And you keep giving more importance to something which just reiterates your belief. So this is what we call as belief perseverance bias, that you're not comfortable changing your belief. So in this case, belief perseverance bias can include a conservatism bias. Now, when I say conservatism bias, you're not conservative in your life per se, but you're conservative in terms of changing your view. You're conservative in terms of being open to new ideas, new suggestions. So they tend to maintain a present belief rather than cope up with the mental stress of updating the belief. Arey yaar, it's too much of thing. I did so much of analysis. I did so much of work to make my belief that India is going to grow fast. Now you're asking me and giving me some other counterpoints. It's too much of pain, man. I don't want to change my belief. But because of that comfort, you can lose money by investing into Indian market. What's more important, the comfort or the money? But even as a portfolio manager, you may prefer the comfort because it's such a painful thing to keep changing your belief every couple of months. You are slow to update a view or a forecast. So let's say there's a portfolio manager who thought that the stock will go up. Currently it's 200, it'll become 500, but the stock becomes 150. This portfolio manager still thinks it'll go up to 500 and buy more and more of it, but it becomes 100. At 100, the portfolio manager even buys more and more, thinking it'll become 500, but again it goes down. So I'm stuck with my 500 view, which I made when the price was 200, thinking that the stock will go up. But rather than going up, the stock is going down. Am I ready to change my view of 500 rupees? No. Something is not right, no? Okay, rather than going from 200 to 500, the stock has gone from 200 to 100. It means I'm missing something. But am I ready to update my forecast and update my view on that? No. So the cognitive cost involved processing those forms of information is higher. So in this case, guys, you hold winners or losers for too long. I'll give you a specific example here. What do I mean by holding winners and losers for too long? Let's say a particular stock is worth 100 and you thought it'll go to 150. But when it goes to 80, it's going against your view. But still you think that it will go up. If not to 150, it'll go to 130. But the stock comes down to 60. When it comes to 60, you still think the stock will go up. If not to 130, it'll go to 100. So every time you believe that the stock will go up, but eventually the stock has come to 40, you still think it'll go up to 70. The stock has come to 20. So the point is that if you could change your view at this point, where rather than going from 100 to 150, the stock has come down to 80, you could not have incurred this much of loss. But you kept your view, or you're changing your valuation, but your view is still that the stock will go up. That view is not changing. So rather than making a loss of 20%, you made a loss of 80% on that particular stock. And that's a bad thing. You could have come out of it earlier rather than later. But guys, the good thing here is that sometimes it works in your favor. And the best example is NVIDIA. I won't give you the name, but there was a particular fund who thought that NVIDIA is a very good stock when the NVIDIA stock price was 100. And this fund said it'll become 150. Within a couple of months, it became 140. But this fund has a positive view. They said it'll go to 200. Soon it became 180. They said it'll become 250. Soon it became 240. They said it'll become 500. It became 450. They said it'll become 800. So in this case, rather than making 40% money and getting out of it, this fund kept being positive and as a result made 4 times the money. So either ways, because you're not ready to change your view, you keep the winners or the losers for too long. If you keep the winners for too long, you make more money. If you keep the losers for too long, you lose more money. I'll stop here. First of all, is it very clear what are cognitive errors, how they're different from the emotional biases? And within cognitive errors, we are going to discuss about belief perseverance bias as well as the processing error. We are discussing belief perseverance bias first, and within belief perseverance bias, we are discussing conservatism. Any doubts, any questions, any reactions, do let me know. Cool. Let's go to the second one. The second one is a confirmation bias. As the name suggests, you're just looking for the confirmation of your current belief. Your confirms prior beliefs and to ignore or undervalue whatever contradicts them. There's lots of similarity. So this confirmation bias is not very different from conservatism bias. So it's similar, but not same is how I'll put it. So in case of confirmation bias, you're looking for a confirmation that your current belief is same. So if you find an information which is consistent with your current belief, you take it as it is. But if it contradicts it, you again ignore it. So you consider the positive information about an existing investment. And this keeps reiterating your view on the stock that it's a good stock. And as a result, what happens is that you put too much money in that stock. You're not ready to look at the other side of the equation. And as a result, most of the time, the portfolio managers who have lots of confirmation bias, they under diversify their portfolio. They invest too much money in a single stock rather than parking their money into different stocks. Give me 1 second, guys. Sorry, guys. So in this case, people who are exposed to the confirmation bias, they'll under diversify their portfolio because they'll put lots of money into a single stock, believing that what they know is correct. So see, hold a disproportionate amount of their investment asset in their employing. Sorry. So there's another thing. Confirmation bias के अंदर क्या होता है ना? You think that the company you're working with, you know the best about that company, and you end up investing lots of money in your employer stocks. So let's say if somebody is working with Microsoft, they will buy lots of shares in Microsoft itself because they think that because they are working with the company, they know more about the company and they're closer to the company. They believe in their company and are convinced of its favorable prospects. So guys, what will be the guidance to these people? Hey, please go out and seek information. And there's a thing called devil's advocate. Be a devil's advocate. Think about the reasons. What makes this stock a bad stock? Because currently you're in a confirmation bias. You're looking only for those news or those information which are confirming your bias or confirming your belief. Be a devil's advocate. Try to think the other way around. What could be the reasons which can make the stock bad stock? So that's nothing but the confirmation bias. The third thing is the representativeness bias. Now, in this case, if there's a new information in the market, you do not look at the new information very, very independently, but you look at it based on the past experiences. So, for example, in this case, give me a few seconds. तो इसके अंदर what you're doing is you're forgetting, you are missing the base rate or the sample size neglect. What is base rate and the sample size neglect here is that in this case, let's say you take a data from 10 people, and based on this data of 10 people, it seems like their annual income is very, very high. So just based on these 10 people, you conclude that the average income of overall India is very, very high. The problem here is the sample size neglect. You did not bother about arguing whether these 10 people is representative of India as a population or not. What if these 10 people you have selected are the people who are studying in a very, very prestigious college where the fees are very, very high? Obviously, for these people, their annual income will be high. But is that representative of India as a population? Maybe not. So in this case, this is what we call a sample size neglect. You took those 10 people as a representative of the entire population, which may not be correct because of the sample size. The same thing is true for the base rate neglect. That may be possible that whatever you're trying to see is applicable on a lower size of the population or on a lower base effect. So because of either these two things, what you see or what you study is applicable only for a lower base or a smaller size, and you apply that, you generalize that for the entire economy or the entire country. Illusion or control bias. Here people have a belief that they control what can happen and what will not happen. For example, some people think that they know when the markets are going to crash. Some people think that they know when the stock is going to go down. So this is something called illusion of control, because be mindful, right? You never know what will happen to the market. So if you think that you have a control on the market, or you think you know where the markets are going to go, that's just an illusion that can never be a reality. So here people believe that they can control or influence outcomes in situations where they actually cannot. So again, they do not diversify their portfolio because they think they're in control. They do more trading than what you should do because unko lagta hai they can predict the market. And I think, Rakesh, you might have some of illusion of control bias. All the traders have this bias. They think that they know how the markets are going to open, how the markets are going to close. In some cases, guys, the people who have an illusion of control bias, they make a very detailed financial model and forecast. Let me tell you, like, the reality of the sales, the investment banking. Let's say if somebody is making a model on Apple as a company, how will they predict? Will they predict the overall iPhone ka sales, overall iPad का sales and MacBook का sales, या will they predict the sale of iPhone के अंदर भी iPhone 16 से कितना आएगा, 15 से कितना आएगा, 14 से कितना आएगा, and within 16 में इंडिया से कितना आएगा, चाइना से कितना आएगा, यूएस से कितना आएगा, iPad से कितना आएगा? What kind of details the models have generally? Guys, may I request all of you to please switch on your cameras again? Anushka, Nadia, I've not seen you yet with your camera on. What do you think? How much detail the company model should have when I'm doing the forecasting for Apple as a company? So somebody who thinks, like I'm in a better control, I know everything about the company, they'll try to predict the sale of each and every variant of iPhone. iPhone 16 का कितना होगा, 128 GB का कितना सेल होगा, 256 GB का कितना सेल होगा, इंडिया में कितना होगा, चाइना में कितना होगा, यूएस में कितना होगा. But guys, this is next to impossible. How do you know? It's right. You can predict the overall iPhone का sales क्या होगा, या जो latest variant है उसका sales क्या होगा. But how will you predict 14 versus 13 का sales क्या होगा, right? So the people who try to predict everything, they just think that they know better. And as a result, their models are very, very detailed. They have lots of forecast into their model, but they think they have a control on all the assumptions. This also results into the CEO of the company, and just not the CEO, but the CFO and the top management of the company having a large stake in their companies. Now, guys, there's a question like if an employee has a large stake in the company, employee is investing the money in the company, then it's a confirmation bias. But if a CEO of the company is holding the shares in the company, then it's an illusion of control. Because the reason the CEO is holding the shares in the company, because the CEO thinks that I can control how the company is going to perform. ठीक है, as an Asian Paint as a company can control how Asian Paints is going to perform. But what if, let's say, there's a new thing in the market where the demand for paint goes down? The demand for paints go down, Asian Paints will also go down, right? So that's the thing, that the CEO owning large stake in the company, thinking that I know what the company is going to do, I can control the company's share price, I can control the company's performance, is nothing but illusion of control bias. So in this case, the guidance or the suggestion to the portfolio manager is that realize that investing is a probabilistic activity. There's no guarantee here. And even if you are the largest investment bank, you cannot control the market. Have you seen the GameStop as a share, like the news and the information about it? GameStop. So this is a particular stock. You must read about it. You must Google all the articles about it. It's very interesting. And I'll just show you the share price performance.
So this is story about something. One boy has did some short selling on वगैरह कुछ तो हुआ था
Yeah,
ना
short squeeze. So
चार्ट
guys,
को इस
like
पे short.
it has gone up from like $4 to $80 within like a year. And then from 80, it became 15 within like a few months. From 15, it went up to 70 within few months. From 70, it came down to 40. And it has been very, very volatile. But again, it was in news very recently, and it went from 10 to 40. If I do a 1 year chart, that's like very interesting. See? So read about it. But in this case, this is a very, very classic case where the retailers have ensured that the investment banks cannot take the retailers for granted. Here, the investment banks have gone bankrupt because they thought that they are in control. They will control the price of GameStop, but all the retailers made a cartel and they tried to push the investment banks. Like, the investment banks were on the edge and they pushed the investment banks off the cliff. Read about it. I don't want to get into too much detail, but that's a very good case what you can give to a portfolio manager who have an illusion of control bias. Hindsight bias. You think that what has happened in the past, you could have predicted everything what has happened in the past. Guys, I think I get it sometimes, no? Just for example, there are many people who tell you, "अरे यार मुझे पता था यार 2020 के अंदर, like something like a pandemic is going to come. I knew that the way the market has gone down, it will recover very, very fast." Did these people tell you in 2019 that the pandemic is going to come? No. They started telling you after the pandemic come, अरे हाँ यार मुझे पता था कि ऐसा कुछ होने वाला है. And I hate these kind of people, right? And you will find lots of people, right? The markets crashed and they recovered like anything. So I've got like tens of my friends who tells me, "Yaar, I knew that the way the markets went down, they will recover as fast as that." I asked them a simple question. Did you invest the money when the markets were down? They said, yeah, but not a lot. No, get lost. Don't talk to me. If you knew that is going to happen, you should have made like lots of money out of it, right? And did you tell me that the markets are going to recover? No. So why are you telling me now when the markets have already recovered? What do I do with that information? You cannot go back in the past and make money. And it's not like these people are pretending or they're bragging, but they really think that they knew it. So they're being honest to themselves. So overestimate the degree to which they correctly predicted an investment outcome. So let's say if you ask a portfolio manager, according to you, how many decisions you've taken in the last 10 years and how many of them were correct? Maybe they will say that 80% of the decisions were correct. But if you ask these people that go and check the data, which all stocks did you buy, how many times you incurred a loss, how much time you made a profit, maybe it won't come up to 80%. It'll come up to only 55% or 60%. But your perception is that you're being more successful. In real life, you may not be successful. Yes, Virat Kohli is a good player. And if you ask him that, okay, what's your perception that how many matches have you won for India as a finisher? He'll say maybe like 50 matches. But maybe the reality will tell only 20, 25, 30 matches have been like that. Sorry guys, I don't want to say anything against Virat Kohli. He's a very good player. Don't come and kill me for that. I'm just making an example here, okay? So they overestimate the degree to which they correctly predict an investment outcome. So in this case, what's the guidance? Investors record their investment decision and key reasons for making those decisions in writing at or around the time the decision is made. So let's say if I'm buying the stock of a particular company, I should write down on a piece of paper that which company I'm investing money into today, what's my expectation and why, and see after 3 months whether the company stock price has performed the way I thought and for the reasons I thought about. कई बार क्या होता है वो luck भी होता है, right? I thought the price will go up because the company will have a higher sales, but the sales have gone down, but still the prices have gone up because the margins have improved. Then can I take the credit for that? No, I should not take the credit because did my estimate come true? No. If you keep tracking it, at the end of 5 years, you can see that, okay, you made 30 decisions out of which only 5 decisions were correct. So guys, this is what we call as hindsight bias, that going back, I could predict everything, but going forward, I can predict nothing. Somebody asked me that, okay, like, how did you know that you wanted to make a career in investment banking? I can give a very, very pretentious answer that, since my 10th class, I knew that I want to get into investment banking. Bullshit. I didn't even know what investment banking is when I was in my 10th, right? Just that I happened to pass out from my MBA college in 2007 when the markets were at peak. The company which came to hire me, who could give me the best offer, was the investment bank. So I was open to marketing as well as finance profiles. Within finance profile, I did not have any preference, but the company which came with the highest package, which could offer me a good job, something related to finance, happens to be an investment bank, and that made my career. But now I can always make a thing, right? Or I knew that I wanted to be in investment banking. Okay, so these were like a few belief perseverance bias, which are part of cognitive errors, which includes your conservatism bias, confirmation bias, representativeness bias, illusion of control bias, and the hindsight bias. Within cognitive errors, we are going to do the second set of errors, which is the processing error, how you process the data, how you process the information. So guys, what I can do is I can divide the cognitive errors into two parts: how you take the information, which is belief perseverance bias, and how you process that information, which is your into processing errors. But both of them is into the collection and the processing of the information. Here, the way you collect information is bad. Here, the way you process the information is bad. So let's get into processing errors. Within processing errors, the first one is anchoring and adjustment bias. So similar again, there's lots of overlap. Let's say your estimate is that company is going to grow at 10%. If there's a new information come into the market which is consistent with your view, you just reiterate that 10% is a solid number. But if something comes which is against your view, you may adjust it up, down a bit, but not a lot. So in this case, you may stick too closely to your original estimate, even when there's a new information coming into the market. Let's say you bought the stock or for rupees 100 and prices have gone down to 70. It looked cheap to you. The same stock which was, okay, this is something else, guys. So one is adjustment bias, which I discussed about you, that you don't make lots of changes to your estimates, even if there's a new information to the market. The other thing is something called anchoring bias. Anchoring bias is different from adjustment bias. What is anchoring bias? Let's say Nvidia share price, right? Let's talk about last 5 years. Let's say somebody bought Nvidia at $5. So just 5 years back, I bought it for $4. Currently, the stock price is $127. What do you think that person is thinking about $127? Is it very high, very low? What's the perception about $127 today? Super high price, right? Because I have the memory that I bought it for $4, $5, $7. So from that level, $127 looks too high. But if there's an investor who invested the money at $136, or not even 136, 120, 125, like in the last 1 month, what's your perception about $126? It's around the same price. I'll give you maybe another example. If you bought the stock at 100 rupees, today 7,000 looks very strong to you. But if you bought the stock at, let's say, 8,000 rupees, the same 7,000 rupees looks cheap to you. So how do you perceive that 7,000 rupees today is based on where your anchor is? If your anchor is at 100 rupees, the price what was there 10 years back, the 7,000 looks like it's 70 times more. But if your anchor is at 8,000 rupees, which was like where you invested the money a couple of months back, the 7,000 looks cheaper to you. But guys, you should not get anchored at one point. You should keep changing that anchor, is the whole point. So you are lucky that you invested the money when the prices were 100. So move your anchor from there and put it somewhere else. But that's a very, very old anchor point. The second one is a mental accounting bias. I'll give you a very real life example of a mental accounting, okay? And see, this happens with me, and tell me if you can relate with yourself as well. And before that, the 10-minute reminder, can all of you request your cameras? Sorry, can you switch on your cameras, please? Nadia, I've not seen you with your camera on yet. I don't even know whether you're around. Nandini, the minute I told you that you've been very regular on your camera, you have started keeping your camera off now. Cool. So this happened, okay? So generally, like I think, you'll judge me, but I love playing poker. So there have been lots of trips to Goa. I've never been to a beach, but I just like in a casino, like from like, for 10, 15 hours and come back. So I don't go to Goa for beaches. I go to Goa for casinos. Now, I'm a very, as I told you some time back, right? Like behavior wise, I'm like very, very, I wouldn't say miser, but I don't spend too much money, right? I'll buy what I need to buy, but I won't splurge money. Like I can't buy an iPhone. I can't buy, AirPods. But any which ways, if you tell me that, okay, 20,000 rupees, is it a good big money for me? Yes, it's a decent money. I'll think twice before I spend that money. When I'm playing poker, once it so happened that, I've won poker many times, but before I come out, I'll lose that money playing the next rounds, right? So it's easy to win money in a casino, but it's very difficult to come out with the money which you've won outside the casino. Because you end up putting more bet, and when you put more bet, you lose that money before you come out. There was one day, I still remember, like, maybe my beginner's luck, that I've had like 45,000 rupees over and above, the chips I bought. And though I wanted to play and just like, take care, it's some money which I've won, just like, let's splurge it. Splurge it as in like, just put it on the games. But it was too late and all my friends have to leave. I didn't have a choice but to, for the first time ever, take that 45,000 rupees extra out of the casino. Like, see, I enjoyed my time and I'm taking 45,000 rupees out of casino for the first time ever. But guys, you know what? With this 45,000 rupees, the way I was looking at this 45,000 rupees was very different. And that point of time, this was equal to like my half a month salary. If you ask me, what will I do with my half a month salary? Will I be careful about it? Yes. But this 45,000 rupees, I cannot tell you, but I just like literally splurged that money. I gave expensive gifts to the friend who came with me to Goa. I sponsored their flight tickets. I paid for the cab. On the way back, we stopped for a dinner where we had drinks, the total bill being 7,000 rupees. I like the way I was treating this 45,000 rupees was very, very different compared to the way I'll treat my 45,000 rupees coming from a half a month salary. And this is what we call as mental accounting. Eventually this 45,000 is same as this 45,000 rupees, right? But I treat this 45,000 very, very different because the way I earn this money is very easy compared to what I perceive this 45,000 rupees to be. Forget about a drinks party. Even if you ask me for like a dosa party, I'm not going to give you. That's a hard-earned money. Ye 45,000 rupees easy money, poker money. That's splurge. Now there's no room for this kind of discrimination in portfolio, right? Because money is money, right? So this 45,000 is exactly same as this 45,000 rupees. So this is a very good example of a mental accounting bias. The way you look at the returns derived from income versus those derived from capital appreciation. The third one being framing bias. Sometimes you frame your idea or you frame your question in such a way that the question itself is biased. For example, let me do this, okay? I'm going to ask you a question and tell me what do you think your answer is, okay? Just like it's binary, yes or no. Yeah, if you look around, there's lots of issues in terms of how India is doing compared to the other countries in terms of their technological investments. There are lots of smart Indians who are leaving India and going to the outside world. So this is the thing what we call as brain drain. The stock markets are just too overvalued because there's lots of euphoria that India will keep doing everything good. I don't know like how much these kind of valuations are justified. Everybody is just like enough FOMO, and they're investing into the market that's just because they don't want to miss out. What's your perception that the markets from here will go up or go down?
Sir,
Don't say it. Put that in the chat box.
go-
What's your expectation that the markets will do from here? I think Rakesh spoiled it. He created a bias for others. But guys, the way I framed the question, I thought, everybody will say it'll go down. I put so many negativity into it, right? Why do you think, by the way, like it'll go up, Priya, Nadia, Rakesh? Why did you say it'll go up?
sir, according to me, so many projects are coming into the India because of China and America clusters. I mean, they're I mean, whatever they're happening with US and China. So IT sector also improving so much in India, and all the I mean, base products. I mean, outsourcing is coming to India,
Okay, so let's not get
and
into those technicals. We can keep
yes,
talking about it. But the
yes.
way I framed my question, did it bias you to be like a bit more conservative? And if let's say you did not have a strong view about India, maybe you would have said, ha, yeah, like what he's speaking makes sense. And you'll be like, ha, it'll go down. So the way I frame question to get the answer can change the answer from the respondents. For example, let's say I'm trying to ask, okay, what do you think about this particular person? And yeah, this person is very, very innocent. This looks very, very intelligent. He doesn't speak loud anytime. What do you think about this person? Is he good or bad? Obviously, your answer will be good, right? Because the platform I've created. But on the other hand, if I say something bad about the market, good about the market, and ask you what is going to happen, there's more chances that you'll be positive about that person or about that market. So this is what we call as framing bias. How do you frame your question? Because your answer may depend on how I'm framing the same question. So one thing is saying there's a 10% chance stock X would go down, which sounds a very, very positive statement. Sorry, which sounds a very negative statement, that there's a 10% chance the stock can go down. Or you can say that the same thing is there's a 90% chance the stock will go up. You're saying the exact same thing, but the way you're phrasing it is a bit different. The fourth bias is availability bias. I only look for the information which is easily available to me. So let's say if I want to do anything about what the CFA candidates look like, maybe I'll take the data from you guys. Because for me, you are representative of a typical CFA candidate. But maybe that's not true. But I'll still consider you as a representative of India's CFA candidates, because this is the best available option for me. So in this case, let's say if I want to study Apple, how the Apple products are doing, rather than looking at the global perspective, maybe I'll just look at the Bangalore perspective. How many people use Apple iPhone? How many people are buying it? I'll take that as a representative of the entire world. Why do I choose Bangalore? Because I'm being based out of Bangalore. It's easy for me to take this survey within Bangalore. So a person may use only a narrow range of experience instead of considering multiple perspectives. So it could be possible that in Bangalore it's being used more, but outside Bangalore, it's not that much in use. So guys, these were the uh, processing errors. So we discussed about the belief perseverance biases and the processing errors, both of them being part of the cognitive errors. Now we are shifting gears and we are going to the second leg, which is the emotional bias, how people behave emotionally. Can you do anything about emotional biases? No. Just being aware of it is the first step. So within emotional biases, it could include the loss aversion bias. I would say like 99.99% people are impacted by this bias or by this virus. What is the loss aversion bias? And this, I can tell you, like, my father used to call me a lot, like, as I told you that this is how the stock markets were, that this was 2006, 2007, this was peak in 2008. The markets were going up like crazy. Every next day morning, the markets will be up by 1%. Some of the stocks were going up by 2 to 3% on a daily basis. So within a month, they are double. Within 2 months, they are 4 times. So I joined a job like maybe sometime in 2007 mid. And from this point of time, the markets were so high. And I used to get my father calling me, asking me which stock to invest into. But the problem here was that, first of all, I was not like doing a very high-end research. I was just like more into data punching stuff, like very, very basic stuff. So this is what you do in the first initial month. You do not become a stock manager the very first day, right? I used to tell my father I don't have much idea. And my father like kept asking me like till the markets reached here. But he had a big FOMO because every friend of his was telling him that how his friend invested 1 lakh rupees, which has become 1.5 lakh rupees within a month or two. And guys, my father decided that, okay, I'm useless. I'm not helping him out. So he bought some shares worth 1 lakh rupees. And he was so good at it that he bought it right at the peak. Now, after buying it, he told me that he had bought some shares. I said, okay. And then I asked him, okay, what's his plan? He told me that, this 1 lakh will become 2 lakh rupees within 2-3 months. So his horizon is 2-3 months, and within 2-3 months, he'll sell it. I said, what if it goes down? No, it doesn't go down. It just keeps going up. And any which ways, like 2-3 months, either 1 lakh will become 2 lakhs, or whatever I get, I'll sell it and get out of it. Now, such an unfortunate thing that maybe that 1 lakh became, and sorry guys, it was not right at the peak, slightly before the peak. So I told my father, don't do this, don't invest and all. But after investing, he called me the next day that how his 1 lakh has become 1 lakh 2,000 rupees. And within 5 days, that 1 lakh has become 1 lakh 15,000 rupees. And then I stopped telling him because I could not be critical, because the data speaks louder than the words, right? But then the thing started, the market started crashing. And guys, neither he spoke about the portfolio nor I discussed about his portfolio because I didn't want to hurt him. But at some point of time when I was visiting my family, he told me that his 1 lakh, which has become 1 lakh 15,000 at a point of time, is now worth 7,000 rupees. Ouch, it hurts. But again, I was mature enough not to keep rubbing salt on his wound. I didn't discuss about it. But it was like, I think in like a couple of years back, like, 2021 ke andar, 22 ke andar, I asked him that, okay, what is your portfolio looking like now? Would have sold your portfolio, right? When the markets were 7,000 points. Well, no, why will I sell it for 7,000 rupees? I'll wait for the markets to recover, right? Like, has the markets recovered? But he has bought some shares, guys, which were so shitty shares. The markets recovered, these shares never recovered. So then he called me one fine day in 2023 that for the first time in the past 16 years, the portfolio has come back to 1 lakh rupees. And at that point of time, he sold his portfolio entirely and took a oath that he's not going to invest in the stock markets ever again. So the moral of the story is that if he invested 1 lakh rupees and he sells it at 7,000 rupees, it means that he took a wrong decision and he accepted that he has taken a wrong decision. And that's the reason he's ready to sell it at 7,000 rupees and incur a loss. But guys, if you don't sell it for 7,000 rupees, his 3-month investment horizon becomes a 15-year investment horizon. And he says, "Arey yaar, mera 3 mahine ka tha hi nahi. Mera was like a long-term investment." And you keep waiting till the markets recover. And as a result, you are just not ready to book your losses. Because once you book your losses, it's a stamp that you took a wrong decision. But if it's a profit, you're very early in booking your profits. But you don't want to book your losses and to commit and to accept that you took a wrong decision. So this bias is very, very prominent among everyone. And this is what we call as a loss aversion bias. You do not want to book losses. So if you don't want to book losses, the thing can keep getting into more and more loss. And this may never recover ever. So in this case, you hold investments in a loss position longer than justified by fundamental analysis in the hope that they will return to break even. So guys, if there's a gain, you sell it too early. But if there's a loss, you don't sell it ever. So keep the bad names in your portfolio for too long. So this is what we call as loss aversion bias. Overconfidence bias. I know it and only I know it. Baki sab to stupid hai, right? Arey, I know this company is going to do good. Why do you know? Why the others don't know? Just that I know I'm the smartest person on the planet. So the overconfidence bias, guys, can be with anyone, but the people who are into investment banking industry, they are more exposed to this virus. क्योंकि उनको लगता है, because they are closer to the market, they know some valuation methodology, they know something about the market, so they know better than the others. But guys, as I keep saying that, Harshad Mehta, Rakesh Jinuwala, Vijay K, Vikas K, these Kedia person, none of these people have a financial or a academic degree, but still they are pretty good about everything. So overconfidence bias, wherein people tend to take too much credit for success, we call it self-enhancing. अरे मुझे पता था, मेरे को पता था, I knew it. अरे पूरा मार्केट ऊपर जा रहा है, तुम्हें क्या पता था? Assign responsibility to others for failures, self-protecting. So if it's good, it's because of me. If it's bad, it's because of you. So if it's good, it's because of me. It's called self-enhancing, that I'm so good. And if it's bad, it's because of others. Not that I want to blame you, but I want to protect myself. It's called self-protecting. So again, guys, because you have so much of overconfidence, you buy a few stocks thinking that you know those stocks very well, and you hold poorly diversified portfolio. You underestimate the risk and you overestimate the returns. Third is self-control bias. People think that they want to do something in the long term, but are they ready to control or make changes in the short term to achieve the long term? Maybe not. For example, let's take your case, okay? Can I assume that all of you want to pass level 1 exams in the first attempt? Yes. But that would mean that you should not be wasting any time. You should be getting up early. How many of you are doing actually getting up early? You should not be watching any Netflix. You should not be watching T20 World Cup, by the way. Oh, my problem is, guys, I always wanted to be very, very fit. I want to, like I'm 84 currently, I want to be 75. My cholesterol is at a border level. I want to bring it well below the border level. Oh, this is what I want. But what am I doing? Am I getting up early in the morning? No. Am I going for a walk? Nope. Am I exercising? Nope. Am I doing yoga? Nope. Am I controlling on my food? Nope. Self-control bias. So people fail to act while chasing their long-term goals. Overarching goals in favor of the short-term satisfaction. I want to eat death by chocolate ka ice cream, and that's more important than for me to achieve my long-term goal. When it is about money, people are generally willing and able to save for the future, but they often have difficulty sacrificing present consumption because of lack of self-control. So guys, I want to have a very good retirement, and by the time of retirement, I have to have a portfolio of 5 crore rupees. But for doing that, I should stop buying fancy stuff for myself. I should stop splurging money. But am I doing that? Am I stopping splurging money? No. But still my goal is to get to 5 crore rupees ka portfolio. How can I do both? So this is what we call as self-control bias. That you're not controlling yourself in the short term for you to achieve what you need in the long term. So guys, you save insufficiently for the future, which may in turn result in accepting too much risk in portfolios in an attempt to generate high returns. So target is 5 crore rupees. But to achieve that target, you should save a lot more, but you're not saving enough. How will you get to that target? You take a lot more risk to get to the same target with less savings. Status quo bias is, I call it like, the lazy bias. You just don't want to change your view. You don't want to change your position. You don't want to change your investments. So let's say you bought a stock and you thought the stock will double. It doubles. Do you sell it? No, you think it'll go further double. It actually becomes further double. Do you sell it? No, you still hold it. Because you think that if it was a good stock once, it'll always be a good stock to get invested into. Okay, you made lots of money because of that, but it can backfire as well because you thought it'll double, but it becomes half. Did you sell it? No. It becomes further half, further half. So next few years, it becomes like almost bankrupt. So you're just lazy enough to explore other ideas, other investments. You're happy with what you have seen and what you've invested into. The fifth one is what we call as endowment bias. Endowment bias means simply like, let's say you are looking for a real estate property, and finally the options are A, B, C. These are the three properties you're looking for, and all three of them look similarly good to you, and finally you decide on property A. You give the money and you get it registered in your name. Now A is just not a property which is similar to B and C. A is the property, you own it now. B and C is what you decided against. Now every information which comes into the market, you'll be biased in favor of A, that A is a better property compared to B and C, because now you own the property. What you own looks better. What you don't own looks bad. So let's say if there's any news about some, another office space is coming closer to building A. See, building A prices are going to go up. If you see any building coming near to B and C, yeah, this area will become more traffic area. The prices will go down for B and C. So you always give more importance. You're always positive about what you own, and you're more critical about what you don't own. So this is what you call as endowment bias, that you like what you own. You value an asset more when they own it than when they don't own it. Endowment bias may be the result of several other behavioral biases, such as loss aversion. So guys, there's lots of overlap, I keep saying, right? So one bias can be the result of the other biases as well. So the question to ask yourself is, would you buy this security today at the current price? So because you own it, it's a good stock. But the question is, would you buy more of the same share at today's price? If the answer is no, then better sell it at today's price, no? So that's a very important question. Why are you not buying more of the security today? So if this stock is good because you own it, it could be because of endowment bias. If it's not an endowment bias, and if you think it's a very good stock, why are you not buying more of it? Regret aversion bias. You don't want to have a regret in investments. So to avert regret, it's important that you do not stick your neck out and don't do anything crazy. You simply follow the herd mentality. So when everything goes down and your portfolio also goes down, you were like, "Arey yaar, it's not me, it's the entire market going down." So it's not about you losing money or not. It's about, I should not have regret. I should not have the guilt. The focus is on the guilt and the regret rather than losing money. So I still remember there was a question in level 3. Let me share that question with you guys. You'll find it very interesting. So this is the question I remember from level 3 syllabus. So don't say your answer, just put that in the chat window. Who you think will be more guilty for the loss? I want to hear answers from all of you. Rakesh, Savik, Nadia, Anushka.
Yes, sir, doing.
Okay, guys, let's see. So many of you said Paul, Nandini, Rakesh, Souvik. Why do you think Paul will feel more guilty?
Sir, because
हाँ बोलो.
uh, sir, I mean he did not given his own analysis, and he just based on some other portfolio manager recommendation, he buys the stock and sell at 80, and he's lost for the 20 rupees. So I thought like that. So
Okay. Only one person, Nadia, said it's David. Why you think Nadia it's David?
Sir, I think based as he's done a lot of research on it and market analysis, at least he had I feel like the loss was less compared to Paul's, but then still he could have like recovered it later on. Maybe that's why he would feel like more guilty, is what I felt, because he's done like more research on it and he would be able to recover it later on, but then he couldn't. I think that's why.
Okay. I don't know. I'll tell you the answer in some time. But anybody else who said Paul is going to feel more guilty? Any other reason compared to what Rakesh highlighted? Souvik, why did you go with Paul?
I like in the first sentence it has mentioned that like he has David has sold the shares in 90 due to market downturn. So maybe like he has some kind of confirmation bias that whatever decision that he has made is correct. But in the second scenario, his the activity is not driven by him; it's driven by some other person. So maybe yeah, like he will feel the guilt because he doesn't have much say in that part.
Okay. Nandini, what about you? You also went with Paul, feeling more guilty. Why?
Sir, because Paul has incurred large loss than the David, and also on the based on some others' recommendation.
Okay. Cool. So I was looking for a correct answer with the correct explanation. Yes, A is the correct answer, but the explanation given is wrong. Now the question is why David will feel more guilty. See, Nandini, what you just said that Paul is going to incur will be feeling more guilty because he's losing 20 rupees rather than 10 rupees. That's being a rational thinking. But this is not how the biased mind thinks. A biased mind does not even bother about the losses. In case of David, so in case of Paul, though the losses are more, but I can always say if I'm a Paul, Arey yaar, what do I do? I was suggested by the portfolio manager. He's so good. He's the person who takes all the decisions. And if he did it wrong, what can I do? Is it my mistake? No. It's the portfolio manager's mistake. Though it's my money, I'm able to pass on the blame to my portfolio manager. In case of David, I'm looking for a scapegoat. Who can I pass on the blame to? But I can't find any person. As a result, I feel more guilty about it. So it's not about losing 10% or 20%. It's about whether I can pass on my blame to somebody else so that I feel less guilty about it. Paul could find that person who he can blame in the form of the portfolio manager. But because David decision is his own decision, he cannot pass on the blame to somebody. So he feels more guilty about it.
sorry sir, यहाँ पे
हाँ.
okay.
practical कुछ नहीं है, मतलब this is like the worst thing, right? Like obviously Paul should be more worried. He should have more guilt because he's losing
हाँ
20% money. But the bias says that David will be more biased. David will be feeling more guilty because he cannot pass on the blame to somebody else. He'll be feeling more regret about it.
अच्छा, रिग्रेट अवर्जन, ओके। तो रिग्रेट इज मीनिंग इटसेल्फ सेज दैट कि मुझे पछतावा, पछतावा बोलते हैं ना।
हाँ हाँ। तो जैसे एक बार ये हुआ था राइट कि वंस वी लॉस्ट माय मोबाइल फोन, ठीक है, एंड देन पहले मुझे लगा मेरे मतलब आई लॉस्ट इट, आई वाज द वन हु वाज हैविंग माय मोबाइल फोन द लास्ट। देन बाद में रियलाइज हुआ, माय वाइफ टोल्ड मी नो नो लाइक यू गिव इट टू मी एंड आई थिंक आई लॉस्ट इट। Guys, all of a sudden I was feeling less guilty about it. You understand what I'm saying?
यस,
So it's not about mobile phone being lost. अरे मैंने लॉस नहीं किया, देखो you lost it. You ought to be blamed for it.
ये तो वो ये वाला सीन हो गया ना सर कि भाई वो सिर्फ सेल्फ सेटिस्फेक्शन बोलते हैं ना सर कि दूसरों ने किया मैं क्यों
अरे बट मोबाइल तो तुम्हारा गया ना, तुम्हारा डेटा गया, तुम्हारा सब कुछ गया, राइट?
हाँ, तो मैं उसी हिसाब से सोच के पॉल का बोला था सर आंसर।
नहीं नहीं नहीं। So to avoid making decisions out of the fear of their decisions turning poor ones, they don't take a decision itself, or they take somebody else's decision and work on that. Regret is stronger when the unfavorable outcome are the result of an action taken versus the result of an action not taken. So you're happy missing out a good opportunity, but you're not happy that you take a decision and that goes wrong. So the best decision is no decision. Decision लो ही मत, regret का तो scope आता ही नहीं है फिर.
सो
So
कैन वी एक्सपेक्ट दिस काइंड ऑफ क्वेश्चंस इन एग्जाम्स?
level 1 में नहीं, but level 3 is all about these questions.
अच्छा, तो लेवल 1 में इससे भी सिंपल रहेगा?
नहीं, similar ऐसा question आ सकता है, but I'm saying level 3 में the number of questions will be more.
Okay.
So they engage in herding behavior, क्योंकि if everybody is going down and they go down, they can always say like यार बाकी सब भी lose कर रहे हैं, right? So guys, that was the regret aversion bias. I'll give you another bias. Huh? So this, like, I don't know whether I discussed with you, but this happened, and again, like my mom is still angry with me on this. So एक बार, like my mom was visiting us in Bangalore, and we were going somewhere, and we found a 20 rupee ka note lying down on the road. So my mom said, "Ki keep this 20 rupees with you. We'll give it to some needy person, or we'll put it in the temple whenever we go next." I put that in my wallet. And this 20 rupee note wala like was the old 20 rupee note jo tha na, like with pinkish, kaun sa color hai, like the bigger note, not the current one which is like a bit more greenish. It was like the pinkish one. After like almost a week, my mom said, "Arey wo 20 rupees tha na, give it to me, I'll give it to this person." I took out 20 rupees from my wallet, but I did not have a 20 rupee note, so I gave her 10 rupee notes. My mom said, "नहीं नहीं 20 रुपए का नोट दो." So I had a 20 rupee note, I gave it to her. बोला नहीं नहीं ये वाला नहीं, वही वाला 20 rupee का note which you picked up. I said that तो I spent. बोला no no, I told you to keep it aside. Why did you use that 20 rupees? You have to give the exact same 20 rupees here. How could we use that 20 rupees? That was not our 20 rupees. That was somebody else's 20 rupees. I said क्या फर्क पड़ता है? 20 is 20, no. But my mom is still angry with that. You use somebody else's 20 rupees to buy something for the family. You getting my point? So that's different kind of a mental accounting. It's not about 20 rupees. It's about that 20 rupee note is different from this 20 rupee note. Similar to my casino thing, right? That this 45,000 rupees is different from this 45,000 rupees. Okay? So these are the biases a typical portfolio manager has. I'll repeat one last time. Cognitive errors you cannot do much about it. You can correct the cognitive errors by having a proper counseling, doing some academic courses, having a technical knowledge. But the biases is something you can't do much about it. So we'll stop here. In the next class, we are going to discuss about anomalies. Another interesting topic. Anomalies means something which is very, very weird, something which should not happen, but happens in the market. So something very interesting. I don't want to give you like half-hearted definition of market anomaly. Maybe when we come next tomorrow, I'll give more depth into it. Okay. So spend maybe like 10, 15, 20 minutes on the anomalies, and then we'll go to the remaining topics. Which are the remaining topics? Let's have a quick overview.
I think last chapter. So these all are the things which we have to consider while the time of the making any trading active or equity investment or trading activity.
Yeah, obviously. So in the last class, we'll do the last topic, which is anomalies, and we'll do this chapter, which is introduction to risk management. And what Souvik suggested, we'll do those fees part, which was not covered in your alternative investment. And we'll do lots of questions tomorrow. Okay.
Sure.
Cool, guys. Thank you very much. I'll see you tomorrow.